A very good afternoon to all the delegates for joining in on a working afternoon. We will like to see that today's time you have allocated to us is of some value to you. Next, please. Next. I'm going to talk broadly on tax planning. Basically, what is tax planning? Vis-a-vis GST we are looking at. Optimizing tax considering the exemptions which are available, deductions maybe in values, alternative valuation methods, concessions to minimize the tax incidents. One could, for example, if the entity is predominantly in exempt sector like healthcare, education, religious, charitable, or agriculture, then maybe we could look at using the exemption available and then planning the structure of the organization. Maybe we can look at breaking them into two parts. Part one will be the exempt entity, and part two would be the non-exempt entity where one would register and pay GST based on whatever services are given there which are liable to tax. A higher level of tax planning could be by those who understand the Constitution of India, the allied laws which are applicable and relevant to GST, legal maxims which is settled of several centuries, then the GST Act rules notification circulars itself by way of drafting and representation to reduce the tax. One of the important aspects in GST, and one of the reasons why many of you must have joined here, is to see how you can mitigate risk. The alternative is to be safe, reduce risk and exposure, avoid disputes to the extent possible. Of course, whenever disputes are unnecessarily raised, illegal disputes are raised, you would have to litigate the same. But then, can we avoid the notice itself? Is a question which is very important. Do not wait for notice to come. Before notice, you could avoid the notice by giving various information. You would all recall last month or this month itself, we had a newspaper report on some 22,000 crores of demand on Infosys. This is a matter which our office itself has won, not now, in service tax era, 10 years back. Consistently, this matter was dropped once the idea that there can be an entity outside and they can have their own independent existence was there. However, this matter was raised again. So instead of waiting for the notice and then paying the pre-deposit and fighting a case which you would win, you could try and mitigate it right in the beginning. Whenever we take any information or advice on GST from experts, please see that it's a written report. Let it not be an oral report. In the sense you call the expert says they are not liable and you just forget about it. That's not the way we would suggest. Sometimes there is a gap between the cup and the lip itself. Therefore, better to get written opinions. If we look at three words, tax planning, we have understood. There is also tax avoidance. Tax avoidance basically is using the flaws in the law to reduce the tax. Now, this is looked at with suspicion by the department, and therefore you have to be very sure that you are not doing anything which is what I would say a dubious method or arranging something which is not true, fake invoices, circular trading. between related entities. These could be avoided, and that type of tax avoidance may be totally avoided. There is a decision of the Supreme Court in McDowell where it specifically says that in the plain reading of the law, if there is a benefit available, use it. But don't use dubious methods and colorable devices to claim that. If you do so, you're doing it at your own risk. Which are the common areas of tax planning which can be thought of? One is what the transaction is not a supply at all. There's no tax. And obviously, there'll be no ITC also. The transaction is not liable for RCM, or the transaction is actually an export of service, but there is an understanding of the department that it is not. Next, please. Further, we can look at lower rates exemptions. Sometimes you look at a lower rate, but it comes without ITC. Higher rate comes with ITC. If most of your customers are B2B who are able to avail ITC, then it's better not to claim the exemption or the lower rate so that the ITC benefit can be passed on. Sometimes valuation itself can be a very good tax planning method. Rule 28 provides that if we are transferring goods to a related entity or even selling to a related entity, and the related entity can take the full credit, full ITC, then the invoice value will be accepted. This is something very important. As far as valuation is concerned, there are a lot of incorrect thought processes of what is deductible and what is not. There are a lot of schemes which are raised. Sometimes they are quite innovative. But essentially, what is it? Does it go to reduce the value of the goods? And if so, the deduction should be available. Keeping credit chain from source to completion full. For example, there is steel being purchased, and the steel is being used in a company. The scrap is again sold to X, and X sells it to Y. Now, whether the scrap which was sold to X had the GST on it, and whether X is registered so that he can pass on that scrap duty or tax to the next stage. And this chain go not only from the vendor side backwards, go to the customer side forward also. See that the credit chain is complete. If there is a break in the credit chain, then there is a possibility that the ITC is not available to somebody, and that becomes a cost. Sometimes planning for credit, for example, rent a cab, whether one can look at taking the credit of the motor vehicle, whether ITC on cement, steel can be used for entities which are letting out commercial property. The matter, of course, is before the Supreme Court, and we do not know how many more years it will take. One more way of tax planning is to ensure that you disclose well in advance and avoid the additional period of demand of 2 years. So you lock it to only the basic period of demand, which is when you don't suppress anything, when you do not mislead, etc. There are, of course, many other areas of tax planning. Some of them are in different sectors, and other faculty will take up after me. One thought process I have is either you should have a qualified, updated resource within your factory, or you should have an expert advisor. Also, look at ABC analysis in all the things. What is the value-wise authorization, and where you need to ensure that you get good advice. All the A category items, obviously, you should have clear advice in writing. Sometimes it is good to get your transactions itself reviewed because they may have different taxes at different levels. And therefore, that could be a once in a at the start, and then maybe a yearly exercise for additional products and services you add. Next, please. I think the next is GST specific. We have to understand that this law of GST is a Khichdi law, and it is bitter. They thought it was a unique law and they were boasting about it. But right from the beginning, we were saying that they have not looked at this law holistically. They looked at some of the worst parts of VAT and put it into this law, worst parts of service tax and put it into the law, central excise similarly, customs, and some other foreign laws. So some of the portions of the law are not in line with the objective of GST, like cascading itself. They promise that taxes will not cascade, but they are cascading. You still have all the 5 fuels, you have electricity, you have stamp duty, all outside the GST law. And these may total to an astonishing 8 lakh crores of credit being denied. This is other than the artificial restrictions which they carried forward from the Senvat law, which they had promised they will not do. This law has had too many changes, mainly focused on overcoming favorable judgments. And this is because the bureaucrats are the decision makers in GST from the time of drafting till today. The finance minister, of course, at times meets the industry and asks them their concerns. But if you have seen her attitude, she's only looking at garnering revenue and justifying all the tax increases she has done. Somewhere they have forgotten that the taxpayers are paying their salaries. They are paying for their excess doles. They are also, of course, paying all of us who are on this particular platform. Dispute resolution mechanism. They said we'll make it very easy, simple, using information technology. Some information technology has been used, but the base is not proper. They have not educated the officers, the adjudicating authorities, the appellate authorities, the authorities for advance ruling. None of them have any exam to take. Tribunal was supposed to be in place in 2018, and now in 24 we don't have a tribunal. We just have some what I would say indications that it may come. All have to approach the High Court. Let me say one good thing. High Court today, especially in all the excesses, jurisdictional issues, is a pretty good place for getting relief.
The agenda today was we have a very short discussion about 20 minutes on this real estate. So I will restrict only to highlight few possible issues to look at from a different thought process, and also take us through the joint development agreement, and if time permits, the question answers at the last. We can go to the next slide. So this is a small snapshot of the rates. Most of you would be aware that there was a change of rate in 2019. So the new revised rate will be 1 and 5% for residential and 12% for commercial. Next slide. Next slide. Next slide, please, Vignesh. Yeah. So coming into this issues as far as the real estate is concerned, one of the things is that whether the sale of flat, is it a sale of building or is it a construction service which is being provided? So this is a very important and open issue which needs to be get settled. Most of you who are there from service tax practicing or doing the compliance from service tax may recall, initially in service tax there was a decision of this Mangus construction wherein it held that when an agreement of sale is done and later the sale is sale deed is executed after the completion of construction, the construction during such period was a self-service. It was done to oneself. And any construction done post execution of sale deed, only that can be held as a construction service provided by a developer to its customer. This decision was accepted by the department. A circular was given, and they told that, yeah, if I say anything, any construction happening post execution of sale deed only would be subjected to tax. Later, they bought a deeming fiction and they told sale deed doesn't have any relevance for taxation. If you are constructing a building which is intended for sale and you are receiving any advance prior to obtaining a completion service certificate, irrespective of when you have done a sale deed, you have to pay the tax on this entire transaction. So a deeming fiction was being bought. The same thing is continuing even under the GST. Initially, this was given as a part of the Schedule 2. Even now, it is a part of the Schedule 2. This I am entering. However, in 2018, they made a retrospective amendment of Schedule 2. And they told that the Schedule 2 is not a deeming fiction. It is only a classification schedule. That means the tax has to be levied in its common, meaning, which is given under the GST Act, which is the scope of supply, definition of goods and definition of service. Only then you can be getting into the tax net. Because the deeming fiction has been removed, whether we can go back to the Mangus construction and still argue the transaction which is an agreement of sale is not a agreement for service, but this is an agreement for sale of immovable property. And the sale of immovable property happens after the self-construction is being done. It could be still an arguable point to say that the GST may not apply on this transaction. So one has to be very clear about this tax position if somebody has to take. You have to be very clear that this will be followed by a notice for sure. But I'm explaining this because that one of the thought process should be known. And once some decision is coming, somebody should not repent or think that, okay, we did not look into it. So that's my idea of getting this point for discussion. The second thing also is that in Supreme Court decision in L&T, they have given a very important verdict where they told that till the customer is coming and booking the flat, the construction done to that extent is a self-service only because it has done to nobody. There was no identified customer at all. This is a second ground or the subground of the first ground. So if not the full, up to the customer coming, if a valuation can be identified, a sale deed can be executed to that extent, that could be still a immovable property, and any construction done over and above only would be subjected to tax. So this could be looked at. Another important issue which comes up is that how is that I am going to treat the additional works? Sometimes the flat has been purchased for about a crore, and later the customer says that there is a requirement of some alteration within the permissible limits by the builder, and they mutually agree the alteration is going to cost another 10 lakhs. So now whether the 10 lakhs should be suffering a tax at 18% or it can suffer a tax of 5% or 1%, 5% only, not 1%, 5% as the case may be. So this depends upon how you are entering into a contract. If you are amending the original AOS and revising the specification and getting into an revised consideration of 1.1 crore, then the tax to be paid is 5%. But however, you are entering into an independent work order, new contract or agreement as to construction, finishing agreement, then that becomes an independent transaction that should be subjected to tax at 18%, and of course, you will be eligible for input tax credit. It's not 12% because in this additional work, there will be no land which is being transferred. Thereby, it will be a full rate of 18%. The tax may have to be paid. Then a very important thing to look at is that most of you are aware that this 5% new rate which has been given from 2019 will not allow you to take input tax credit. So now when the maths has been created, maths has been computed, in most of the cases, it has been seen that the project is having huge input tax credit because of dealing with the organized vendors. So there is a substantial amount of GST paid on the expenses, and over and above on the sales I have to collect and pay another 5%. Overall impact of the project is increasing. So a lot of builders are having this talk whether can I, instead of paying 5%, can I pay 12% and go for taking input tax credit? This also could be explored. The option could be is yes, because of one reason, that this one-third deduction, this 5% rate is more like a concessional rate, and notification makes a reference of the exemption notification also. And hence, if it is a conditional exemption, non-fulfillment of a condition should attract not the concessional rate, the normal rate. Here, one of the condition is not to take input tax credit. And the moment you have taken an input tax credit, the concessional rate would not apply, and a normal rate of 18% can be paid, and a deduction towards the land can be taken, which can be a deemed deduction of 1/3 or an actual deduction, which I'm going to explain in the next slide. And the input tax credit can be taken. Here also, it is very important for one to analyze the market sentiment. The market may be having a sentiment of paying only 5% tax on residential. And the moment you say it's 12%, although the base price is less, there could be a lot of marketing impact on this project. So if at all it has to be there, one is that you should be ready for taking the dispute by the department. And you should also have a proper marketing strategy when you are going at a 12% scheme. Next slide, Vignesh. Then as far as the valuation is concerned, so most of us are aware that the actual rate of GST to be paid on residential complex is 7.5% and commercial is 18%, and is an affordable, it is 1.5% affordable residential. However, the rates of 5%, 1%, 12% comes because of deduction of 1/3, which has been given on value. Generally, people apply it on a rate, and thereby the effective rate is coming at that rate. Now, the question comes up is that I am doing a project, maybe in a place like Mumbai or any uptown place in the major city. The land value will be substantial. It will be more than 60, 70% of the total value. But the notification gives 1/3 deduction across all locations, all the projects. So thereby, can I look at taking an additional deduction of the land, which is 70% in one of the example which I've told? Answer for that is yes. This has been confirmed by the Gujarat High Court in case of Munjal Manish Bhai, where they have told that if you are able to get an actual valuation, the deeming valuation which has been given in the notification cannot be enforced, and it cannot be a backdoor sale of a land. They have also given one very important indication saying that the value of construction could also be looked at as a cost plus 10%. So that deduction of the land should not be substantially more than the cost plus 10%. If this has been managed, the higher deduction of land can be taken. This also can be explored for villa or a row house projects where there is a substantial land which has been given. And you could also look at an model of selling the land and doing a construction independently on the sold land, where the construction attracts 18% with ITC and the land will not be subjected to input tax credit. So this could be a good value additive and a planning activity which could be looked at. Of course, we need to consider various parameters how the department is going to look at. Subject to that, this is one of the good way to look at tax planning in real estate is concerned. Can I go to the next slide? Next is ITC. When I'm looking at ITC is mostly on the commercial projects. So 5% and 1% residential, you don't get any input tax credit. But am I eligible to take the input tax credit on the development rights? I'll explain on the development rights in a while, in a joint development product. So it is a tax which has been paid on exchanging the built-up area along with the development rights from the landowner. This should be eligible for input tax credit. However, there is a small catch, is that when this development rate has been taken from the landowner and further sold to the customer my built-up area along with undivided share of land, I am taking a deduction on 1/3 towards the value of the land, and this development right is in proportion to that 1/3, and thereby there could be a dispute which may be raised by the department. In this case, it is very important to understand is that development right receipt is a service. However, sale of land is deemed to be 1/3 and a deduction has been given on the valuation, and thereby it is not a separate transfer of development right or a transfer of land transaction which has been happening, and thereby the development right should be looked at an input for the entire real estate business and not an input towards 1/3 deduction, and thereby the ITC on the development right should be eligible. However, this is one of the gray area. Just wanted to bring this important aspect for the people who are doing commercial projects because the values of this would be substantially high. Coming to the construction service, most of you would be aware that there is a decision of the High Court in case of Safari Retreat, where they have held that you will be eligible to take input tax credit, which is pending before Supreme Court. Pending before Supreme Court, you can explore an option of availing the input tax credit and not utilizing it. This will ensure that you are doing good with the timelines. You are not exceeding the timelines. Second, you would also have that opportunity to wait for the Supreme Court and take a decision accordingly. If you have availed the credit, not utilized it, there will be no implication of interest and penalty. Thereby, one has to explore this. Second is the credit on equipments, independent of Safari Retreat decision. If you can identify the equipment such as the DGs, your lift, HVAC systems, firefighting equipments, all those things, if it is an independent equipment, not a part of the building, would be eligible for input tax credit. Thereby, a separate procurement of this has to be done, and you will be eligible for input tax credit. Furnitures and fixtures also you will be eligible for input tax credit. And very important is that the change of intent, can I take the credit back? So this is one of the challenge which comes up. Initially, I want to do a commercial project for myself. I don't want to sell, and thereby I don't take any input tax credit at all. Later, I get a good price or my business dynamics changes and I want to sell. I will not be able to take input tax credit because it becomes time bar. You should have taken the input tax credit by maximum November of the next financial year. Now it's already 2 years cost, and thereby I'll not be eligible to take the credit based on the time limit. So one has to be very clear that irrespective of the intention, you may have to take the input tax credit, and if you are not selling it anyway, there will be no utilization. And once there is a change of intention that you want to hold, you can reverse the input tax credit, which will not have any impact on your costing and no interest and penalty also. However, if you are not availing the credit, you may miss totally. So thereby one has to carefully plan this. Next slide. You can go to the next slide. I'll go to the joint development agreement. Next. Very important is a joint development agreement. I have another 10 minutes for me to cover. I'll be slightly taking about 4-5 minutes extra than the time allotted. In the next 10 minutes I'll be doing. Go to the next slide. Yeah, so this is a typical multiple transaction in a joint development agreement could be there. There are two transactions. One, landowner giving development right to the developer, which is transaction 2 here, and developer giving the built-up area to landowner, which is transaction 1. It is important to note that GST is not a tax on property. GST is a tax on transaction in the property. So if there is a two transaction which is happening in a one single JDA, then both the taxes has to be independently examined and the tax has to be paid. And it cannot be told that there is one transaction and paying one tax will take away the other tax. Go to the next slide. Go to the next slide. Next slide, please. Yeah. So this transaction number 1, what is the implication of GST? The GST has to be paid by developer by collecting from the landowner if it's permitted in the joint development agreement or in your negotiation. Transaction number 1 is a flats handed over to landowner, which is a construction service done by the landowner. So the logic is very simple. If it was not against exchange of land, but it was a construction was taken from an EPC contractor for payment of money, then the EPC contractor would have charged GST at 18% and you would have paid that to the EPC contract. The only thing which is changing here is instead of paying that in money terms, you are exchanging it with a land. So thereby the construction service what has been taken by you would be still be applicable and the tax has to be paid. One could also argue saying that no, it is not a construction service for which I got a consideration as land. Because I have taken a land, I am giving a part of the built up area. Whatever can be happened, it is two transaction. One has to be looked at what is the thing which you are passing on. What you are passing on is a construction service. Thereby it would be subjected to tax. The valuation for this would be the sale nearest to the DA-GPA or joint development agreement. Rate of tax is 1 or 5 as the case may be. And it is important to note no input tax credit on all the construction expenses done by the developer. And the tax has to be paid at the time of completion certificate or first occupancy, whichever is earlier. You can go to the next transaction. Next slide, please. This is a taxability of TDR, transaction number 2. That is a land which has been given or a TDR which has been given by the landowner to the developer. Here also the liability to pay is on developer, not on the landowner. However, the tax has to be paid only to the extent of development rights pertaining to flats which is unsold by the developer. And the rate of tax would be 5%. Value will be the sale value nearest to completion certificate, not the first occupancy. And you will not be eligible to take any input tax credit. And the tax has to be paid at the time of completion certificate. Next slide, please. This is a simple illustration just to explain the scenario. Whatever I have told, but with an illustration. Consider there are 100 flats in the project. 60 is belonging to landowner and 40 is belonging to the 60 is for the developer and 40 belongs to the landowner. And out of 60 belonging to developer, 50 has been sold by him pre-completion. 10 is unsold as on the completion agreement, completion certificate date. And the same ratio with the landowner would be 25 and 15. So with this, we'll see how the impact of GST would going to be there. Can I go to the next slide, please? So here 50 flats which has been booked by the developer, by the various customers of the developer. Tax has to be paid at 5% and no ITC will be eligible. You have to pay at the time on the transaction value based on realization or milestone, whichever is earlier. I think this is pretty known to everybody. 10 flats unbooked as on the completion certificate, no tax on the sale of this 10 flats. Please mind my words. I'm saying no tax on sale of this 10 flats, no tax to be paid. 40 flats which has been given to landowner, you have to pay 5% tax on that. You will not be eligible for ITC. Value will be the first sale value and the tax has to be paid at the time of completion certificate. Now the comes as a confuser or a changer is that there are 10 flats which is unbooked and the TDR pertaining to this 10 flats, the tax has to be paid by the developer under reverse charge basis. The rate of tax applicable is 5% and the time of payment is at the time of completion certificate. So 50 sold to customer, tax paid at 5% on transaction value, 40 given to landowner, first sale value, 5% tax, 10 unsold, not on sale, but development right on the 10 unsold, 5% into last sale value, you pay the GST. So in sum and substance on the entire 100 flats constructed by the developer himself pays tax on the entire 100 flats at the rate of 5%, maybe at a different valuation. So this is how a joint development agreement compliance needs to be done by the developer. Next slide. This is the compliance to be done by the landowner. Whatever the 40 flats he receives from the developer, he has to pay 5% to developer as good as a recipient. Of course, if it has been provided in your joint development agreement, you are eligible to take input tax credit. For 25 flats, when you are pre-selling, pre-OC, you are selling to the customer, you are eligible to offset this 5% tax. Pay 5% on the output tax. Here, one condition is your output value should be greater than your input value. It should be greater than your first sale value, which has been taken for assessment. For the 15 unsold flat, no GST to be paid, but you have taken the credit on 40 flats, you have to proportionately reverse to the extent of 15 flats if you have already taken the credit. So this is the compliance in the hands of the landowner.
So I think for the participants, it would be little interesting and maybe sometimes little difficult also for moving from one sector to the next sector. So while my co-speaker Sudhir had spoken about the real estate sector, while Sudhir had spoken on the real estate sector, I will touch on some of the critical issues in the automobile sector. So before I touch upon the issue, if we broadly understand from the sector point of view, which all players in the industry are there in a typical automobile sector. So one is that OEM, original equipment manufacturers, wherein we see all these brand owners, Tata, Hyundai, Kia, all these companies who are the actual uh, uh, equipment manufacturer called as OEM. So that is one side on which various GST implications would arise. Second are various vendors of these OEMs. So these vendors are called tier 1, tier 2, up to tier 3 suppliers, depending on to what extent or who is their customer. So if somebody is supplying directly to Maruti, then he would be like tier 1 supplier also, so on and so forth. Third category would be the customer interfacing category, wherein these OEMs typically appoint their distributors or dealers, and these distributors and dealers would be undertaking the actual sale transaction and post sale service with the customers. So that is the third leg of this automobile sector. So what we would try to discuss some of the critical issues what are being faced at the respective end from the sector perspective. While these all are these, I would say, manufacturer or supplier of automobile sector, many times as a business users, we also deal with the automobile sector, either maybe purchase of the automobile vehicles or getting the vehicle insurance, servicing, etc. done. So there are also various issues what could arise for a businessman. So maybe if depending on the issues covered herein, we'll touch upon some of those aspects also. So maybe if you move to the first issue, if you move to the slide. So first is the classification of parts and accessories of motor vehicle. So I think this has been one of the biggest issue in the automobile sector. So typically, let me explain it like this. So if you look at any automobile, automobile is classified under chapter 87 in the scheme of classification in the Customs Tariff Act. So chapter 8701 to 8705 deals with various type of automobile vehicles, depending on whether it is for the transportation of goods or transportation of passenger or special purpose vehicle or so. There is a specific heading 8708. It deals with the parts and accessories of the motor vehicles. Now the typical question what many times do arise. So let us say if I am manufacturing certain fasteners. So these fasteners are like typical nut and bolt which are used for adjoining two different components, two different parts. These fasteners are used not only in the automobile sector, but in various other engineering sector, other equipment, manufacturing, etc. also. Now, let us say as a fastener manufacturer, I am supplying these fastener to the OEM, let us say Maruti or Tata or to any of these OEMs. Now the question arises that these fasteners, when I am supplying to OEMs, would it be treated as part and accessories of motor vehicles, or would it be treated like a normal product which is capable of being used in the multiple ways? Why this issue arises? If it is said to be classifiable as part and accessories of motor vehicle, then appropriate heading would be heading 8708. And the applicable tax rate in the chapter 8708 is in the heading 8708 is 28%. But if it is held to be not classifiable under 8708, and if it goes in the respective chapter, in most of the situation, it would be classifiable at the rate of 18%. So in this example, if the fasteners get included in heading 8708, it will be subjected to 28%, else it would be taxable at 18%. Now this entire issue has arisen because of the after sale market. Because when somebody is selling to the OEMs anyway, they do charge 28% on their further supply to the dealers and then to the end customer. But when it goes to the after sale markets, which are like distributor or these unregulated service centers or so, many times there it happens that the product may not necessarily be of that standard quality, or many times the paying capacity of the customers could be less, or if 28% tax is charged, then there could be resistance from the customer to take the billing and all those stuff. So these tier 1, tier 2 vendors typically intend to supply these parts and accessories in the after sale market at the rate of 18%. The same item, if supplied to the OEMs, then they cannot segregate basis the user because there are no end use based classification. So that is where the problem arises, whether it should be charged 18% or 28%. Now here it would be important to look at the section note and chapter note of the scheme of classification. Why this is important? Because like when Madhukar sir was speaking in the beginning, it is a Khichdi law. So the classification in GST, what the legislation has done, they have adopted the classification as per the Customs Tariff Act. And when the classification has been adopted as per the Customs Tariff Act, wherever any ambiguity is there, wherever there is need of getting into further examination of appropriate entry, because your rate notification under GST does not brings out in detail as to the manner of determination of classification, one need to go to the Customs Tariff Act. So in the Customs Tariff Act, if we look at the section note, section 17, which is relevant to chapter 87, it lays down 3 criteria for the purpose of determining whether a product should be classifiable under parts and accessories of motor vehicle, or it should get classified in the respective chapter wherein that other part, if not used for the motor vehicle, would have fallen. So one of the condition is that if that item is defined as a part of general use, in that situation, that part will get classified under that part of general use chapter, not under the chapter 87. So in my example, this fastener, if we can establish that this fastener is parts of general use, then classification would be under that respective chapter. But if we are not able to establish that it is parts of general use, then we'll have to go to the chapter 87 and subject it to 28%. So the parts of general use, what they have defined, there they have linked it with certain specific heading of the tariff act. So like this example here, articles of heading 7307, 12, 15, 17, 18 and similar articles of other base metal. So if your article is made out of the base metal and if it is falling into these headings, in those situations, even though that item is used for the automobile component or as a part of automobile, still it will not be treated as part of general use, but it would it would not be treated as parts and accessories of motor vehicle, but it would more appropriately be treated as parts of general use. So in this example where we are talking about the fastener, because it gets covered in 7318, this would get covered in the parts of general use and accordingly taxable at the rate of 18%. It will not get into chapter 87. This is what the scheme of classification says, but there is a long history jurisprudence on this particular issue and large number of issues have arisen on account of that legislative history. So if I move to the next slide, I'll just touch upon maybe some of the important aspects. So first I'll take this GS Auto International Limited Supreme Court judgment, which was on the fastener. So this judgment is way back in pronounced in 2001, but the issue here pertains to the period prior to 1989. So here what had happened at that point of time, Indian HSN were not aligned with the international HSN. So at that point of time, Honorable Supreme Court, basis the reading at that relevant HSN at that point of time had taken a view that these fastener would be treated in parts and accessories of motor vehicles, not the parts of general use. And if that principle is applied in GST, then it would get covered in 8708, which would make the manufacturer at very disadvantageous position. Basis this judgment, department had raised demand on various players. DRC1A were issued. So while we were examining this issue and when we had represented before the North Block also, we came across that this ruling was issued at a point of time when Indian tariff was not aligned with the international tariff, and in 1989 when tariff were aligned, after that point of time additional condition was inserted in that section note. So because of that section note, this ruling which was given at that point of time does not hold good today. But because department has been blindly relying on that earlier ruling, they have issued DRC 1A to various players in the sector. Later on, there have been jurisprudence development in case of Westinghouse judgment, which was in 2022, then Uni Products, Intel Design. So in all these cases, the principle was laid down that this part of general use versus part of special use has to be properly seen before taking a view of classification. Still, the issue persisted. So then department, if I move to the next slide, then department had to intervene and they issued an instruction. That instruction had provided for the classification determination basis these principles. So if anybody has been facing that issue of classification, they have to very clearly distinguish with developed jurisprudence on the matter, because there have been various updation in the jurisprudence itself throughout this period. As of now, department DGG has accepted at most of the location that it is subjected to 18%. Not 28%, but some of the state authorities are not yet accepting that proposition. Now, if I look at the second issue, that is the passenger vehicle versus vehicle for transportation. So, again, if we look at section 17.5, which prohibits or blocks certain type of credits, it provides that if your vehicle is for the passenger transportation and if it is for sitting capacity more than 12, then you can take the input tax credit. But if it is vehicle for transportation, in that situation, once it becomes vehicle for transportation of goods, you can take the input tax credit without any restriction. Now, many times it is very clear, okay, what is the passenger vehicle or what is the vehicle for transportation? There are not much dispute. But sometimes the construct or usage of the vehicle could be dual, which could partially be used for the passenger or maybe partially used for the transportation. So in that situation, the question arises how to determine the passenger vehicle versus vehicle for transportation. So here if we go to a scheme of classification, again chapter 8703 and 8704, which deals with the vehicle which are predominantly meant for transportation of passenger versus transportation of goods, there certain criteria are laid down to determine whether this would fall into category A or category B. So while making any purchases, we need to keep in mind those criteria to evaluate whether the vehicle is falling into which particular category. And it is not only falling into particular category, it would also be relevant to see the usage of those vehicles for a particular objective. So if we look at like ITC on the cash delivery van. So if we look at the cash delivery van, so while it is used primarily for the transportation of the cash and other valuable items by the banks, but it also has the sitting capacity wherein maybe up to 6 persons can sit for the purpose of safeguarding that item what is being transported. Now the question arises, would it be passenger vehicle wherein passenger can sit, or would it be vehicle for transportation? Certainly here the primary intention is to transport the cash or other valuable item which are more in the nature of transportation of goods and related stuff, not the passenger vehicle. Similarly, like pickup truck, etc. also, wherein the I would say passenger can also sit along with the cargo also. Here again, it would be important what is the primary objective and the construct or manner in which that vehicle has been designed. So some of the tests, if we see what have been laid down on the next slide, which are coming essentially out of that scheme of classification, that when it is vehicle for transportation of persons, then yes, normally if we see there would be presence of permanent seat with safety equipments, or there is likely to be rear window along with side panel, then doors with windows, then absence of permanent panel or barrier between the area for driver and rear area, like normally when we see in any of the truck also, where there is disconnect between two different part of the vehicle, then presence of the comfort features, interior, finishing, furnishing, etc. Vis-a-vis, if you look at the transportation of goods vehicle, many of these attributes would be missing or would be otherwise falling into those type of vehicles. So here it becomes important for us to properly identify what is the nature of vehicle before we take a position as to input tax credit. If I move to the next issue in the sector, next issue is valuation of design, molds, tools, etc. So typically what happens, what used to happen in the central excise regime, if I am a supplier of component to an OEM, for the purpose of manufacturing those components, I need to get certain dies and tools designed, manufactured. The ownership in those dies and tools, etc. are always with the customer. But the excise law was always on the intrinsic value of the goods. So while the ownership in those goods would have transferred to the OEM at the beginning of the contract itself, but amortization was done for these molds, tools, etc. by the component supplier, wherein over and above the component price, that amortized value of the dies and tools were also included. So if the component price was 40 rupees and the die tool, let us say it had costed 2 lakh rupees, which can manufacture 2 lakh components. So 1 rupee per component was the amortized value, and tax excise duty would have been charged on the rupees 41. But now if you look at the GST, here GST is little different because it is not the tax on the intrinsic value, but on the tax on the value of supply. So here in this case, when the 2 lakh rupees is the initially billed by the supplier to the customer or to the OEM, at that point of time, there would be supply of that item on which GST would be paid on the very first day. Subsequently, when the components are sold, at that point of time, because the tax has already been paid on 2 lakh rupees at the initial outset, there is no need of amortization of that 2 lakh rupees in the subsequent component sale by to the vendor to the OEM. But sometime it may happen that the scope of this tooling is not in the hand of the customer, but in the hands of the component manufacturer itself. But actually it is developed by OEM rather than the component manufacturer. So in that situation, the value of those goods by virtue of section 15 subsection 2 needs to be amortized by the supplier, by the component supplier to include in their transaction value. So it becomes important how is the contract worded between the parties so that proper amortization or not can be considered by the supplier. This was the one issue on the valuation of design molds, etc. Second issue, what comes here in this is sometime what happens, the OEM is outside India. So when OEM is outside India and design and molds are developed in India, these design and molds are not transferred physically from India to outside India, and the charges are recovered from the foreign customer. So the question arises, would it be export? If yes, would it be export of goods or export of service? Or what would be the nature? So essentially, if we look at any molds or dies or tools are developed, the essential value in that contract is of the intellectual, the designing charges and all those stuff. Because the value what goes in the metal being used for that item is maybe not more than 20-25% of that entire value what is being recovered from the customer. So the question arises, is it a sale of goods or is it a supply of service? So it all depends on how the contract is worded between the parties. Sometimes some of the parties do recover these charges as a designing charges from the foreign customer. And when it is recovered as a designing charges, the view is taken that the place of supply of this service would be the recipient located outside India. While if it is said to be the sale of goods without giving too much emphasis on the designing service, then it is sale of goods where the movement of goods from India to outside India does not take place. And when this movement is not taking place, it cannot be treated as zero rated supply and it becomes subject to GST. So very importantly, we need to see what is the nature of transaction, what is the contract, how it has been structured between the parties, how the movement is taking place before we take actual tax position, because many times we have seen that while the billing is made as a design charges for services, but actually the PO by the customer or the underlying contract speaks everything as if it has been made as a supply of goods. So we need to be very sure in terms of the tax position, and there has to be consistency between the tax position and the underlying document in this regard. Maybe if I touch upon a couple of other issues, if I move to the next slide, it deals with the bus bodybuilding. So that was also a very big issue because if the, let us say sometime what happens, the chassis is owned by the principal and the what you call bus bodybuilding is done by some other person. So in that situation, whether it is transaction of 28% as a sale of bus as a vehicle, or is it 18% where a person is working on the job work basis. So what the circular had laid down is that if the chassis is owned by myself and I am making a bus bodybuilding also, in that situation, it becomes a single supply of the bus to the customer, and that being a single supply, it would be subjected to 28%. But if the chassis is owned by some other brand owner, that principal, who has supplied that chassis to me, and I am doing that bus bodybuilding designed around that chassis, then my supply would be supply of service as a job worker capacity, on which I need to charge 18%, not the 28%. Mind you, here that normal rate of job work 12% is not applicable because of a separate specific entry in the rate notification. So again, it would be very important to see how the contract is structured, what the roles and responsibilities of the respective parties are. That would help in determining the appropriate classification and appropriate rate of tax for this particular activities by the different parties. If I move to the next slide to touch upon the other aspect of debit note for price difference. So in this sector, again, if you look at, there are periodical price adjustment on account of maybe price escalation of the underlying metal and all those stuff. So whenever these price adjustment are being done at that point of time, debit note is being raised by the component supplier to the OEM. The question arises whether this debit note, what is being raised for the price difference, whether it would be subjected to interest under section 50 thereon or not. If we recollect, under the central excise regime, there was judgment of Honorable Supreme Court in case of Steel Authority of India Limited post GST. This judgment was there, wherein it was held that the supplementary invoice or debit note raised is subject to liable to interest. But if you look at the GST, there is subtle difference in terms of the legal provision, because the section 12, explanation 1 to section 12, it says, it provides that supply shall be deemed to have been made to the extent it is covered by the invoice or the is covered by the payment, and where the invoice would include the debit note also. So if my original supply was, let us say, at 80 rupees, my time of supply for 80 rupees would be as per original supply. Later on in the future, because of certain reason, the price get escalated by 2 rupees. The time of supply for that escalated 2 rupees would be in the future date when that actual debit note is raised, not on the very first day, when the value itself determined on all parameters on that particular day was the fixed 80 rupees. So in this case, there are issues raised by department, but this explanation 1 to section 12 could be very handy to contest the matter on the merit that interest is not applicable in case of such debit note. Maybe if I move to the last issue of this particular thing, ITC on demo vehicles. So this become relevant for what you call distributors, where they normally have the demo vehicles with them to for the purpose of test drive by the customer, prospective customer. So we know that ITC cannot be claimed for motor vehicle used for transportation of person. But if we look at these distributors, these people are not having these vehicles primarily for the transportation of person, but it is more as a part of the sales promotion for their business, wherein they need to have these vehicles for the purpose of the customer testing those vehicles if it is fitting into their need, criteria, etc. So there are the divergent ruling, though advanced ruling cannot be relied on by the other customer or other taxpayer, but certainly it has the persuasive value. Independent of the advanced ruling, if we see these demo vehicles are not meant for like in any other business, but it is specifically meant for a specified purpose, which is in the course of furtherance of business. Certainly the view what should be taken is that it is usable, or it is for the purpose of a specific purpose, and ITC should be available. And not only this, it is not that these are owned permanently. After certain point of time, these are sold also. So the 17.5 also provides for taking ITC when the vehicles are taken for the purpose of further supply. So the demo vehicles interim period have the usage of demo, but later on ultimately these are being supplied. So looking at all these situations, here one could certainly look at taking input tax credit on the demo vehicle. Maybe Divyesh, if you move to the next slide. Yeah, maybe these are some of the issues faced by the automobile dealers. But primarily, if I just touch upon one issue, is the discount, what they receive from the OEMs. Because the discount is for the quantity sale also, sometimes these automobile dealers show it as a other income in their books of account, and revenue treats it as an independent supply by these automobile dealers to the OEM and seeks to levy tax on that particular transaction. But yes, these are not the separate supply, but these are the purchase discount for lifting certain quantity by the automobile dealer, and these purchase discount cannot be subjected to GST. There has been, I would say, settled jurisprudence in the erstwhile regime. The same principle should apply in the GST also.
Capable of having a full day session, so we are trying to give you a snapshot of whatever could be the best value added points. If you look at healthcare, so normally whenever we have interacted with the some of the top healthcare institutions of the country, the initial discussion is that boss, my major turnover is exempted. What is that will yield as a benefit to us if you do a review exercise for the particular organization, a GST review. But let me tell you, you can actually unlock a lot of value and give a significant value addition to that particular organization if you are able to assess and understand some of the specific dynamics of this industry, and significant value addition certainly can be put forth before the clients, which we have done successfully across some of the large healthcare organizations in the country. Divya, if you can move to the next slide. I'll also try to make up for the time which we have slightly exceeded. So mine is a very simple one-slider discussion, but we'll try to cover the significant points which can help you to unlock value if you are having certain clients in this healthcare segment, or if you are actually working in the healthcare industry. Can you click once, Divya? Yeah, thank you. So the first point is with regard to this cross-charge and ISD requirement. Though many of us look at ISD today as a mandatory requirement which is going to be effective from April 2025, let me tell you, this ISD as an option itself is something which we need to really consider to minimize the tax cost or to enhance the benefit of input tax credit what we can achieve. If I have to give you an example of an healthcare sector itself, what was happening is that the head office was availing credit on various common expenses. As a practice, they were doing a cross charge of those expenses to other locations. Typically, in a healthcare company, a company which has the healthcare segment which is running hospitals, so the average percentage of taxable turnover is about 8 to 10%. That is the historical trend which we have seen. Certain exceptional sectors which have a higher level of taxable turnover. If I take an example of a hospital which takes care of eye treatment, where there is going to be sale of spectacles and other eye lenses, there the taxable turnover ratio will be slightly higher, about 20 to 25%. So here typically if an healthcare company is looking to avail credit at the head office location and do a cross charge invoicing to all its other locations, we are effectively creating a reversal of input tax credit in two GST in one, which is in the hands of the head office. Second, once again, the recipient state location who is getting the cross charge invoice, they will also have to do a reversal under Rule 42. So net, though my taxable turnover is 10%, I may actually end up reversing about 95 to 96% of the credit, because the kind of benefit which is available under Section 17(4) for financial institutions, NBFCs, where they have a standard 50% credit eligibility irrespective of the exempt turnover, that is not available to the healthcare sector. So this is one of the suggestions and recommendations we had actually given to the ministry, but not considered, is to allow the 50% credit benefit like what has been allowed today for the financial sector. So this, though not looking from a mandate perspective, certainly it is having a significant savings for the company if they actually follow the ISD mechanism. And anyways, going forward from April 25, there is no option but to implement and follow this ISD as a compliance process. Can you click once again, Divya? Thank you. The second point is this input tax credit. I think this is with regard to the further extended benefit which can be achieved in terms of optimizing the credit eligibility. And typically this has been one area which has been ignored significantly, because if you look at an healthcare organization, the primary focus is always on the operations part of the business, which is taking care of the services of healthcare, and the taxation generally does not take a significant seat in terms of the focus of the management. So here what we have also seen is that there are a lot of hospitals who have an in-house pharmacy, means there is a healthcare organization which has an hospital providing healthcare services to both inpatient, outpatient. In addition to that, they will also have a pharmacy division or a chain of pharmacy which are located across various hospital chains which they have. Normally, the approach of the hospitals is to have a single GST registration where all the billings are done, whether it is for the healthcare services or for the pharmacy sales, is done in the single GST registration number. Now, what needs to be done in terms of a value unlocking is a simple math calculation to identify the cost benefit analysis of having a single registration for the entire organization in that state vis-a-vis multiple registration for that particular company in the same state. When I say multiple registration, we are trying to see if we can have one separate registration for the services division and another registration which is purely catering for the pharmacy division, which is concerned with the sale of pharmacy products. But now this conclusion, as I said, requires a math to be done. What can be assessed is that there could be a lot of common expenses. For example, the hospital rent. Now there is a case where there is a hospital which is having a total floor area of 1,50,000 square feet, but the pharmacy area is hardly 10 to 15,000 square feet. Now the question which came up was, if my taxable turnover ratio is about 15%, okay, my benefit of credit, whether I can avail in proportion to my taxable turnover for the GST which I have paid to my landlord for the hospital rent. Many of the hospitals have a thought process that since the major area has been occupied for providing healthcare services, pharmacy being a very small area, 15,000 square feet is actually a higher area, I would say 1,500 square feet. So it's hardly 1% of the floor area space occupied by the pharmacy. So there we have settled precedents which have held that when the law has provided a particular mechanism and a procedure to be followed, you have to follow the procedure as is. It is in the context of Rule 6 of the Senate credit rules. You cannot go by any other methodology for computing a particular tax benefit or a tax computation which has been provided in the law. If you look at Rule 42, the computation mechanism is simple and clear. You only have to consider expenses which are having a common nature, where the consumption or the utilization has been done both for taxable as well as exempted supplies. So in case of an hospital rent, certainly it's a common expenses. So straight away you just need to assess the ratio of the taxable turnover to take the benefit of credit. So this is something which I think most of you would be aware. But the alternate option which is available for evaluation is having two separate registration. Now how does this help? If I take the case of pharmacy, where it caters to both inpatient as well as outpatient. So for inpatient, typically it is being given to the respective nurses who are taking care of the patient, and finally the patient would get the bill with the entire breakup, which includes the healthcare services, the stay, maybe the operation theatre charges, and the pharmacy medical bills. Now if I have a separate registration for the pharmacy, I will have a situation where the registration which is covering the pharmacy division will charge GST to the registration of the hospital registration, which is purely into the services of healthcare. So now to that extent, my hospital GST registration will not take the credit. But what happens is I will be eligible to take full credit at the initial stage of procurement of pharmacy items at my pharmacy GST registration. Now in any healthcare sector, you will not have cases where they are placing the orders for pharmacy products or pharmacy items separately for IP and OP, except when it is an operation theatre or an OT related procurement which happens. So in such a case, generally they will go for reversal under Rule 42 basis the taxable turnover. But in effect, what happens is that my taxable turnover is substantially lower, not purely because of the medicines which I have supplied to inpatient. Typically, the ratio of medicine supplied for inpatient and outpatient could be about 60-40 ratio, where 60 could be towards inpatient, 42 could be for outpatient. But this exempt turnovers increases substantially from 60 to about 90% or 95%, because there is a significant amount of healthcare service income which gets added to my Rule 42 computation. Now, if I consider this particular option, I will be eligible to take full credit of pharmacy procurement in the pharmacy registration, no reversal required, as and when I am supplying pharmacy items to the GST number of the healthcare division, they will not be taking credit. So if in effect, the cost of ITC or the cost of procurement having a GST element will be limited to the actual consumption of inpatient medicine, which roughly will be about 50 to 60%. So that could be a significant value unlocking which could be possible. But in this particular option, you will have a possible reduction in the amount of ITC which you can get for the common floor area, which I have told as the first example of the GST on the rent paid. So you need to do a cost benefit analysis for one of the healthcare groups where we had done the assessment. We had seen that there is an annual benefit of about 1.5 crores which can be achieved by opting for the second option, which is a separate registration, where generally the pharmacy will also have a central store location. So that can be the place of business for which you take the registration. The other locations in the hospitals, in-house pharmacy where they exist, can become additional place of business. So that is with regard to optimizing the ITC where value addition and unlocking of benefit is possible. Divya, the last one, can you click please? Thank you. The last point is with regard to again RCM. Here again there are a number of opportunities and possibilities, I would say, to enhance the benefit of credit as well as at the same time reduce the cost. That is basically what the industry also wants, how they can minimize the cost burden on account of the taxes. So one of them is the allocation of credits between common and direct. So if I take an example of RCM paid for, say, buses taken on rent, because you might have seen that various hospitals today, buses running up and down on a daily basis, moving their medical staff, because as the country is growing, the importance of medical facilities has substantially increased, and the manpower requirement also has increased significantly. So then hence there is a major requirement of this transportation which has been picking up in this industry. Now typically what happens is the hospital company or the hospital entity will have a set of hostels or an accommodation taken for their employees, where the medical staffs are moved from and to the hospitals through buses. Now here the point which can be considered as a value unlocking is, instead of having all of the people in the bus which are purely for providing healthcare services, can you have a case where few of the non-healthcare staff are also part of the occupancy in the bus? So for example, if I have my admin staff of that building also moving in the bus, then it becomes a common credit from a direct expenses for exempted turnover. So if there is a possibility, see how you can make an expenses from direct ineligible to a common credit and maximize the benefit of ITC. The last point for my discussion is the recent update which had come for the exemption with regard to accommodation services. So we all know that, I know Divya has kept a video on because time is almost up, but since Ashish has taken some time, I'll just finish in 2 minutes. So the entry is with regard to accommodation services which has been exempted, provided the stay is for a minimum continuous period of 90 days. Now it is not a new entry. We also had an entry earlier which was covering HSN 9963 and 9972, which was for renting of residential dwelling except when it is provided to business entities. So that was the exemption which was available. Now they have only covered 9963 as an accommodation services. So here also what we can look at as a value proposition is, can I get into this exemption entry by having this accommodation booked in the name of individual employees, and me as a company providing healthcare services will be making payment directly to the landlord on behalf of the various medical staff who are being stationed in that particular accommodation facility. By doing so, I merely act as a connector between the employee and the landlord, where I merely channelize the payment, which is part of my CTC cost, by which I can overcome this particular hurdle of liability under RCM, because significant cost will get piled up on account of this GST paid under RCM.
Good evening, everybody. Now I'm going to talk about pharma industry. Pharma industry basically consists of medicines, food supplements, that is known as nutraceuticals, and cosmetics. Pharma industry is a very highly regulated industry. Drugs and Cosmetics Act and rules made thereunder is applicable, which is administered by State Food and Drug Administration. There are many challenges in pharma industry, but considering the time available, I'm going to discuss two most important issues in pharma industry. The first one is issues in classification of pharma products, and second issue is on certain transactions on which ITC, whether it is eligible or not. The classification means it is a segregation of goods or services according to their nature and characteristic and assigning these headings and subheadings. Because since the pharma industry is also covering the products of nutraceuticals and cosmetics, it is very challenging to classify whether it is a medicament or cosmetics or nutraceuticals. They are very closely knitted, and many are having or sharing common factors. When the classification is not done properly, then there are challenges with regard to rate of tax applied. Exemption could have been wrongly applied, or exemption would not have been availed, and also certain compliances like RCM and other things which are specific to particular chapter heading, then there can be some challenges. So classification is very, very important in pharma products. Next slide. See, these medicaments, also known as medicine or patent or proprietary medicines, also formulations and drugs. These are all the different terminologies used for the same product. In the Act also, sometimes it is called formulations in DNC Act. Sometimes it is drugs, sometimes it is PRP medicines. So all these things are referring to only medicaments. Then what are the various factors one has to consider for the purpose of classification? The first and most important thing is its therapeutic or prophylactic value. Therapeutic means its ability to cure a disease, that is a curing aspect, whether it is there or not. Prophylactic means prevention of disease, whether this particular product prevents any disease. These are the two important aspects. Either one has to be present to classify a particular product as medicaments. But mere presence of any of these two cannot make anything as a product or medicines. Because even in case of cosmetics also, some of the product may be having either therapeutic or prophylactic value. Similarly, nutraceuticals, that is food supplements, nowadays very much in popular, they are also having this therapeutic or prophylactic values. Then what should be the criteria? What other factors we need to consider? There are many such many other important aspects one has to consider. The most important would be FDA license. Food and Drug Administration issues the license for manufacturing, marketing, storing, and distribution and selling of these pharma products. For allopathic, different type of licenses. For storage, different type of licenses. For selling, different type of licenses. Similarly, for nutraceuticals and cosmetics, also different types of licenses are issued. This gives a clear indication that whether this particular product is medicament or not. In addition to that, there are other factors also, like the prescription by doctors. For every medicine, prescription is not mandatory. There are some medicines which are included in Schedule H to the DNC Act. Then doctor's prescription is mandatory when it is to be sold by the chemist shop. So that gives a very good clarity that this particular product is a medicament. And period of use, as you are all aware, these medicines are not used permanently unless the disease itself is like that, like diabetes or cholesterol, certain things like that. Otherwise, generally medicines are used for limited period of time. So this also gives an indication whether that particular product is medicine or not. Then the last and most, again, the important aspect is trade parlance. Trade parlance theory means how that particular product is known in the market, whether it is used by the consumer as a medicine or whether it is used as a food supplement or cosmetics. That also at times plays major role while deciding the classification of the product. So most important is FDA license, then trade parlance, and also its and other theories are to be considered at the time of classification of these medicines. And of course, the important ingredients is therapeutic or prophylactic nature of that particular product is a must to decide whether this particular goods is medicine or not. Next. Some important or interesting case laws, the hair wash or shampoo, normally I think it is a cosmetics, but it was having some therapeutic value. That's why it was treated as, classified as Ayurvedic medicine by High Court of Madhya Pradesh in case of Global Telemol. Similarly, in case of Kandilwal Drug Agency's case, a swab having therapeutic value is medicine, though it is sold in tea stall or betel shop. So where it is being sold is not important, but its use was found to be more important for deciding its classification. Again, in case of CN laboratories, it has been held that if a product's primary function is care and not cure, it is not a medicament. Cosmetic products are used in enhancing or improving a person's appearance or beauty, whereas medicinal products are used to treat or cure some medical condition. So these are some of the interesting case laws I thought I need to share. Next slide. Then issues in ITC. There are many things or many activities in pharma industry which poses certain challenges with regard to ITC. I'm discussing 2-3 items considering the time. One is physician sample. Physician samples means samples given to the doctors or medical fraternity as a sample to see the efficacy and effectiveness of the medicines before they start prescribing the product. This marketing company or manufacturers distribute free of cost to the doctors some portion of their manufactured or their products. This is given free of cost. Since there is no consideration involved, the FAQ has clarified that it is not amounting to supply, no GST is payable. However, what about ITC? Because section 17.5H clearly says when goods is disposed by way of a free sample, ITC is restricted. Now, physician samples are normally distributed free of samples only. It cannot be sold. Now, there are two situations. One is physician samples would have been manufactured in their own factory by utilizing the inputs and their own manufacturing facility. The input tax credit is taken on input and input services used in the course of furtherance of the business. The manufacturing activity is also one of the activities specified in the definition of business. It means once the input is put into manufacture, it can be said it is used in the course of furtherance of the business. The eligibility criteria for availing the input tax credit has been met with. Once the inputs are put into manufacture, then ITC is eligible. Subsequently, manufactured goods are cleared without charging any consideration. That is, the manufactured goods are given as physician samples. So, in my view, that should not be a challenge, because what item on which you have taken ITC is used in the course of furtherance of the business, and physician sample is the finished goods manufactured utilizing the input. So you have not procured physician samples free of cost in this example. In another situation, normally what happens, your own products or your own branded medicines are manufactured by third party on a contract basis, and you will be purchasing those medicines as including physician samples at an agreed price, and such purchased physician samples are further free distributed to the medical fraternity. In such case, you are not allowed to take the input tax credit, because simply you are purchasing it and selling it as it is without doing anything on it. So this is one critical issue with regard to physician samples. Other thing is goods returned for destruction. See, the pharma industry, the goods are subjected to shelf life. After shelf life, it cannot be sold to consumers. It has to be destroyed as per the provisions of the law. And the goods are distributed normally from the manufacturer or a marketing company to super stockist to stockist to then this medical shop, that is druggists or chemists. So when the product which are lying with this medical shop nearing expiry or already expired goods, it will be returned to their distributor and distributor to super stockist, and so from super stockist to manufacturer or the marketing company. In the same chain of distribution line, these goods will move on. Now, the time expired goods can be returned under the two different documents. One is if the time limit is available to issue the credit note as per section 34. Then under the credit note, the goods may be returned, this expired goods or damaged goods may be returned by the chemist or the druggist to their distributor, and again distributor to super stockist, and super stockist to manufacturer or the marketing company. If the time limit for issuing issuing credit note under section 34 is already over, then circular has clarified, circular number 726, that it can come under tax invoice also. That means this this chemist shop will issue a tax invoice to the distributor, again distributor to super stockist, and super stockist to manufacturer or the marketing company. So the clarification given in the circular with regard to ITC is that when the goods are destroyed, this time expired goods or damaged goods are destroyed by the manufacturing company, then in case it has come by way come under the cover of tax invoice, then ITC should not be availed. If it has come under the credit note, then upon destruction, the ITC attributable to manufacturer should be reversed. This is what has been clarified, because the section 17.5H would be applicable for such transaction. Then the third important aspect is promotional items. See, it is very common that pharma companies are giving many freebies to doctors. Substantial amount is spent on that. But there was one regulation issued by Indian IMC, Indian Medical Council, which is a statutory authority, wherein the doctors are not supposed to take the freebies given by the pharma companies. So there was a restriction, and what are those freebies, what amounts to freebies, also clarified in that regulation. Based on that regulation, Income Tax Department denied the allowance of these promotional items given by pharma company in the assessment of pharma companies. These pharma companies, when they approached the tribunal or even a high court also, it was held the IMC regulation is applicable to doctors. It is not applicable to pharma company. In other words, giving freebie is not illegal. Only accepting freebies by doctors is illegal. Thereby, the expenses were allowed. Matter went up to Supreme Court. In case of Apex Laboratories, Supreme Court said the intention of the legislature was to ensure that doctors are not induced to prescribe costly or unnecessary medicine. That is why this particular regulation was issued by Indian Medical Council, and it does not mean that it is applicable only to doctors. Accepting freebie as well as giving freebie, both are illegal and it cannot be allowed. So considering this particular ratio, though this decision is in income tax, it may be applicable even GST also, that ratio, because when the intention of the legislature is to curb the practice of giving freebies to doctors, then ITC on the same also could be denied. Though it is used in the course or furtherance of the business, so this expenditure will be denied by the department. However, this regulation is applicable only for the freebies given to doctors. If it is given to other than doctors, like maybe other people involved in the chain, like distributors or chemical shop, then there should not be any challenge for availing the input tax credit. However, what is to be done is there has to be documentary evidence and clear inventory records which shows this these are the things which are distributed to other than medical fraternity, and these are the promotional activities done for the medical fraternity. In that case, other than for medical fraternity, we may be able to take the input tax credit.
To all of you, and let me get into my session in which I will be looking at some of the value additions which may be possible for the textile industry. Can we go to the next slide? Yeah. So here in the textile industry, there is a concept which is there of various kinds of the agents who are called as either a commission agent, or they could be nomenclated as buying agents, or they could be nomenclated as the selling agents. So you may ask that what are these different categories of service providers who are there to the textile industry or the textile manufacturers? So first, let's look at the buying agent. The buying agents are the service providers who are engaged in providing certain specified nature of these services from a very, very long time to the textile sector. What are these services which these agents are providing? These are largely the pre-procurement services which could be there, or it could be also post-order fulfillment services which could be there. As an example, if we have to take, there are several of these buying agents who are situated in India, who are supporting for the hubs wherein the manufacturing activity pertaining to the textile industry takes place, including in Tirupur in South India. What is it that is the functions which are being done by them? It will be involving, let's say there is a European-based buyer of the garments, which is a conglomerate. And this European conglomerate will approach the Indian buying agent and ask for certain services, wherein they will be requiring from them to do a due diligence of the proposed suppliers of the garments or the textile goods to the European company, wherein they will be required to go to that particular factory, see whether children are being employed there, see what are the kind of hygiene conditions which are given, whether adequate safety and security has been ensured for the women who are working in those factories, because there are a lot of compliance requirements which are in place in the European side of the market, wherein they are required to procure only after doing certain checks and balances from the Indian garment and textile suppliers. Also, this may involve the recommending of the suitable suppliers. So a list of the probable prospective suppliers of these garments and materials and textiles will also be provided by the Indian buying agent. A list of suppliers, their contact details also may be given. And in addition to this, also the post-order activities will be done. So then this order and the finalization of the selection and the finalization of the possible supplier, let's say of Tirupur, will be done only by the foreign party, who is the foreign client, which is the conglomerate, let's say Mark and Spencer. So they are going to be finalizing the supplier from India. They are going to be finalizing the prices of the goods, and the role of the Indian buying agent will not cover all these aspects of finalizing the suppliers and finalizing the pricing and all those things. However, in addition to this pre-procurement activity, certain post-procurement and post-order fulfillment service also will be done by this Indian agent. What are those activities? What could they be? It could be checking on the order status to update to the European company, guidance to these manufacturers of Tirpur on the trends, developments which are there in the international European market, communicate on the deviations in the quality delivery schedule, if any, seeing that all these aspects are being well reached to the foreign supplier who is procuring these goods from India. Also, the advice on the international requirements will be done by them to the Indian suppliers. So herein, if we see, the key is that they are involving only for the pre-procurement and the post-procurement or the order fulfillment services. The Indian person does not have the powers to finalize the orders, finalize the pricing for the foreign principal or the foreign client who would have appointed the Indian buying agent. On the other side, we also have some selling agents who may be there in the picture, wherein they are ensuring that the goods which are being sourced from abroad to India. So therein again, they are being appointed by the foreign supplier who becomes their client, and wherein they are going to be ensuring that that foreign supplier of the goods to the Indian market will be having a clear-cut indication of how is the market here. So there'll be some pre-sale activities which will be done, as well as the post-sale activities which will be done by this Indian selling agent to the foreign party, who is the foreign client, could be located, let's say, in Europe. So there could be market research which will be done, pull out the list of the potential buyers in India so that the foreign exporter will be able to understand the tastes and preferences in India, and then also do some advertisement, maybe promote for the product so that he will be able to get the interest which is expressed by the prospects which are in India for those goods which will be supplied by the foreign exporter from there. Here also, we have to be very clear that the roles and responsibilities of the Indian who is the selling agent will not be covering the finalization of the prices, finalization of the customers, finalization of the orders. So in that situation, the question which has been arising and in fact creating some confusion and problems for these agents, so-called buying agents or selling agents, is that whether because they are doing certain activities within India, whether it can be said that they are liable to GST or not, or whether it can be said that they are doing an activity which can be said to be supplied to a foreign beneficiary, foreign consumer of their services, since the principal who has appointed them is situated outside India. They may be also getting the payment in foreign exchange. So whether they should be taxed under GST is a question, or whether it is an export of services which is taking place. Can we go to the next slide? Yeah. So here, where is the question of taxing these transactions coming from? So if we see from the pre-GST period and now in GST as well, the department has been also looking at these category of the service providers who are providing the support to the textile industry, be it on the procurement side or on the sales side. And they are demanding that the taxes should be paid by alleging that they are nothing but a commission agent or an intermediary. So then what happens if somebody is said to be an intermediary? And first of all, who is an intermediary? So here we need to look at a fundamental concept which is there, is that GST will be leviable if the place of supply of the particular service is said to be in the taxable territory of India. So then, to determine whether a service is said to be supplied in India or not, we may need to go to the IGST, wherein there is a specific section 13, wherein they have set out in various subsections what are the different services for which the place of supply will be determined based on the category of the service. So therein there is something called as an intermediary, where it says that the place of supply for the intermediary services would be the location of supplier of service. And this is the classification where the department has been consistently seen to raise a demand on these kinds of the buying agents and selling agents from quite some time. And even in GST, this trend has been there. Intermediary has been defined in IGST. If you go to section 213, wherein it sets out that who is an intermediary? An intermediary is a person who is enabling the supply of the goods or the services between two or more other persons, but does not cover a person who is providing the main supply on own account. And for this, the place of supply is location of supplier. So just by nomenclating them to be a agent or a commission agent or a buying agent or a selling agent, it does not automatically determine, the nomenclature will not determine the taxability of a transaction. What needs to be seen is what is the nature of activity, whether it will fall into intermediary, the work which is being done, executed by these India-based so-called agents, whether it will fall as intermediary. Because remember, it will get covered as an intermediary, then place of supply is India. But if not, then it can fall into the default residuary category, which is the place of supply will be location of the recipient of the service, which goes to another section, that is section 13.2. And if a recipient who is located outside India, is the principal who has appointed this person as an agent in India, is situated outside India, he is liable to make a payment of the consideration, and the invoice also is raised to him, then certainly it may be said that place of supply will be that location which is outside India. And if all the conditions to treat as export are satisfied, where supplier is in India, recipient is outside India, place of supply is again location of the recipient outside India. These are two distinct entities, and also payment in foreign exchange is taking place. Then such a transaction will validly fall into export of service, and there is no liability to GST either. When they are doing it under LUT, no need to pay GST. Corresponding credit is eligible. Now, how do we make a distinction between who is said to be a commission agent versus who is a person who is said to be an intermediary? Okay. So herein, I would say an intermediary is a person who is involved or is having the powers to finalize the prices of the supplies taking place to or by the foreign principal. Okay, and also he will be involved in the negotiation of all these prices. So if that power has not been given, then certainly that will be one very important key factor, though this person, never mind, is being called as a commission agent, as a nomenclature. Even if commission is being given, automatically we cannot jump to a conclusion that a person becomes intermediary. If the scope of service is clear-cut, mentioning therein that he is acting on a principal-to-principal basis in the agreement, that he is not having the powers to finalize the orders nor the prices for the purchases and sales of his foreign principal, then certainly it will come out of the intermediary category, and then it may certainly fall into the support service, where the foreign principal has outsourced certain activities to the Indian, person who is the agent and who is providing those services which are only restricted to the pre-purchase or pre-sale or post-order fulfillment or post-sale services. Can we go to the next slide? So when is it a support service? So how to make this determination? So if department were to come, how to put across in a convincing manner that the nature of service is falling into the export of service basket, since the recipient is outside India. Agreement is paramount. There is a decision also of Supreme Court of the Mahindra case, Mahindra vs. Mahindra, wherein they have said agreement is paramount since it expresses the intention of the parties. Scope should be very clear, that what is the nature of the service which is given. It is a support service which has been outsourced by the foreign principal. Okay, and the deliverables should be documented, because just by telling that it is market research which is being done here, or understanding the tastes and preference of the Indian customers for a foreign exporter is not sufficient. Those reports will have to be documented in a file or a folder. If there is a regular, meetings which are taking place, maybe some presentations are being done by the Indian service provider to the foreign principal, which will be capturing all the trends and the preferences of the Indian market, or a due diligence report has been prepared on the kind of the working conditions of the, Indian suppliers or the Indian factory, which is located in Tirupur, to the European, principal for submitting it to him. list of the emails of the prospective Indian vendors who may make supplies to the foreign procurement company of Europe. So all these things has to be made into a folder by the client and preserved, so that even if the department were to come and look at this particular matter, and if there is an allegation that it is an intermediary and it be taxed, still these documents can be used. The agreement can be also used as a backup to support the claim of what is the nature of the service and why it is covered in the section 13(2), and the place of supply is outside India, drawer in principal, paid in foreign exchange, export of service, do under LUT, no GST. Should not have words like agent, on behalf of, it is being done. Should commission be paid? If it's on cost plus basis, maybe it is more suggestible. And also remember, commission, if it's a very high amount, then why will a small amount, smaller amounts of commission will be paid if there is any kind of a very basic service like bringing two parties together and finalizing the orders, only securing orders, finalizing orders. Then, okay, maybe 2% commission. If it's say 6% commission and there is a whole gamut of service being done, then certainly it can be used to support, substantiate that though it may be paid on a commission basis, nature of activity is so and so, so it is not falling as intermediary, or it will not be taxed as a agent services. And very important, mention that the powers to finalize the orders and the prices are with the principal itself. So all this should help to safely claim that it is a export of services, which is a support service function which is being done to the foreign entity. There are, of course, lately decisions also on this matter, which have come even in the GST, starting from the EY judgment, which had come out from the Delhi High Court, and followed by numerous other decisions, including BOK case and various other cases in the context wherein they have clearly distinguished intermediary and confirmed that it is an support service to be treated as an export of services. Also, there is a circular in this regard for further clarity, which may be referred by the participants, Circular 165/59 of 2021, wherein they have clear-cut mentioned if it is a main contractor has subcontracted certain supply of services to another person, then it will not fall into intermediary, it will fall into the support services category. So with this, I have finished one of the value additive aspects for the participants. Let's go to the next one. Input tax credit on the immovable property. Herein we do recall that in the section 17(5), wherein they have set out the blocked credit list. Therein they say, even in respect of the works contract service, that the credit is eligible only if it is used to make an onward supply of the works contract. Works contract, we know, is a contract where material labor goes hand in hand. Let's say an example could be construction of a building. It can be a factory building, it can be an office. Okay. There is also one more thing, which is a block credit item, which is where there is the goods and services which are used for the purpose of construction, renovation, repair, alteration, etc. of any immovable property or a building, which is for own use. Like if a textile factory is coming up, which is being constructed, it is for own use as a factory premise for the manufacturing activity of the manufacturer of textiles. And therein, if they are making certain procurements of goods and service for the construction, and it is being capitalized to the immovable property block, this particular building, then the credit is blocked. Credit is eligible, available when, let us say, it is a person who is a real estate developer. And therein, he is doing the construction, he is bringing in the materials, he is doing an onward supply in the course of construction, let's say a commercial complex, charging the GST at the effective rate of 12%, including 1/3 land value deduction. So therein, if you see what happens for the purpose of this, optimizing the credit for a construction of a textile factory. This is something we had looked at on numerous occasions, and we were been able to add a lot of value to our clients on this particular aspect. So as we can see, that in the context of a factory which is being constructed, it is not just the building works which will be put up or the civil works which will be put up. There will be so many other aspects also which will be required to be done. There will be the supply and installation of the plant and machinery. There could also be the requirement of doing some support structural works for some of the, let's say, transformers or for generators or so on and so forth. Also, HVAC systems may be put in. So here the point comes, are these immobile? What if the single contract is given to a contractor? Whether the credit will be restricted, whether the credit will be denied. So in this particular context, I can recall that there was this contract which had been given, and the client came to us at the stage of structuring this transaction itself. We could add, the optimization of credit benefits to him there. So the contract which was entered was for the civil works of the building, and also for the same contractor, in the same contract also to be giving the machines and putting up the racks and the storage spaces and ensuring that all the furnishings, the electrical fittings, the wirings, everything also had been done. It was an end-to-end contract for this building plus the other works. So plus material and labor was going hand in hand. It could be said to be a works contract. So if you recall this block credit item, which I said works contract credit would be restricted unless it is used to make further works contract. So developer can take the credit, certainly. But in this case, as per the strict reading of the provision, the credit would have been likely disputed or blocked. So therein we have looked at breaking up this entire contract into its elements. What were these elements? Some were movables. The machinery would be movable, certainly textile machinery, which is covered in chapter 85, 44, 47. So that is all the movables itself were there. Then there were also the other parts, like there was the HVAC system, there was the FTP sewage treatment plant. So those may be immobile. So where first we may like to see what is an immobile versus what is a mobile. So if you see immobile in the normal course, it is understood as a common understanding that something which is fitted onto the civil foundations or attached to the earth and which requires to be so attached for its beneficial enjoyment and may not have any intention to remove or move it from there. So that may fall as immobile. For further, idea on movable versus immobile, solid and correct engineering works case can be referred. But certainly immobile may be distinguishable from something which appears as immobile on the first glance, but it may be possible to be moved or removed. These days, we do see all the time, there are instances of the structurals, even buildings which are coming up, which are based on the nut and bolt technology, which though it appears that it cannot be removed or moved without any damage, it appears to be movable, but actually, if you look at the blueprint design, it's possible to move it, remove it. Maybe some work will be involved, but it is possible to be done, reinstalled and functional elsewhere. So in that context, when we looked at that particular contract, we could see that while one portion was the building work, which was clearly the immobile part of it, okay, which was going to get capitalized to the immobile property block, and credit on that was restricted as per the provision. But the other movables were there, the plant was there. Now, what about plant like your HVAC or the sewage treatment plant? Because once it is put in a place or it is installed with all its parts and components, it cannot be moved or removed without damaging or breaking it into pieces. It cannot be functional again. But therein, if you recall again in section 17.5, they have given one exception. They say that the credit on the goods and services used for the construction of the building, reconstruction, renovation, etc., or any, of an immobile property for self-use is restricted or barred, but its exception is created for plant and machinery. So credit on plant and machinery is eligible even if it is immobile, which once it is installed, if it is removed, if and when removed, it will get damaged, cannot be reused or will not be functional. So the credit on these HVAC systems, which is comprised of this pump and tubings and everything, as well as some civil work therein, it will still be very much available. Why? Because exception is created for plant and machinery credit, even if it is immobile. And AC is a plant. There is even a old circular 58 of 2002, central excise, which we can use in support. Decision of Virdi Brothers Supreme Court also confirms that. So then, when separate independent contracts are entered, so in one contract on the plant and machinery, all the movable, the furniture, the chairs, the tables, The racks, everything was put. The textile
ma'am.
manufacturing machinery, everything was put.
Time, ma'am.
Yeah, I'm almost done. So then the credit can be segregated, safely taken on all these mobiles and plant and machinery items, which will not be denied. Balance civil work, how to take. Next slide. I'm almost done. I'm closing now. Yeah. So the electrical fittings, again, it's eligible because it's mobile. Racks, cabinets, again, mobile. So what was left over is that the civil works. So that also we suggested they can avail. Reverse it to a temporary reversal, where in 4B2, in the 3B. Based on Safari decision, we suggested them to avail it, not to utilize it. Safari decision, as we know, wherein in the context of construction of a commercial mall, they said that the credit will be eligible on the goods and services which are used therein. Even though it is a self-use, it is used to do outward supply using that particular mall and its premises. Credit should not be denied. Equally, it should be given like it is given to a developer. Orissa High Court said that. Supreme Court presently matter is pending. So then reverse it and continue to carry that portion of the credit in the books. So if I have to summarize, there is no requirement to have the clubbing of the different elements, the mobiles, the plant and machinery, and the civil works in the single contract. Certainly, independent contracts may be ensured. For the mobiles, the goods portion separately. For the machine, also separately can be done. And for the immobile property of the civil works, have a separate contract. And that you can avail, reverse it temporarily. If favorable judgment comes, then there's no time limit, re-avail that particular item of credit. Continue to carry in current assets, the credit separately, till such time that the favorable decision is there of the Supreme Court.
Good evening, everybody. One of the disadvantage of being the last speaker is that most of the points would have been covered by the earlier speakers. So there is also some advantage from it. I'll try to cover those points which have not been covered by our previous speakers. Can we move to the next slide, please? Yeah, this meaning I'm not going to cover as Madhukar sir has already covered it. One of the important thing in order to ensure that we take maximum benefit or avoid any cost leakage and ensure that there is a cost control or reduction is by understanding the law. A best example is if as a taxpayer, I don't know the provision that I have to display the GST number in my board outside my office, then I may end up paying penalty which can go up to 50,000 rupees. Therefore, understanding the law is very, very important. So most of the times, if I'm a businessman, I may not understand the law. I don't have enough time. And ideally, I should not be concentrating on understanding the law much, right? So it is for the experts to understand the law. In such cases, I should make sure that I have a good training system within the organization wherein the person who is taking care of GST compliance, he is well versed with the law. Or I should have a good consultant who can take care of this GST compliance so that I don't end up paying unnecessary taxes, interest, or penalties. So these things are very, very important in order to ensure that we make maximum use of this GST law before getting into any tax planning. There are many common errors which needs to be corrected early. You would have seen in the slide which was presented for cost control and tax planning. So there is one booklet which we had come out on cost control and tax planning. So this we can share it with all the participants. If you show your interest and share your mail IDs, you can just say interested to get this cost control booklet so that we can arrange to share the soft copy of it, wherein you can get to know many of the points with respect to this cost control or tax planning. It is also important to make sure that we have a system of studying the system first. You can hire a consultant, or if you have a good person in-house who is well versed with the law, we need to make sure that he studies the system which is there now. We have to understand what is happening with the GST compliance now. If GST department comes for audit, so what are all the issues which can come up for which I need to prepare and comply? Then we should have a standard operating procedure. The advantage of standard operating procedure is not only understanding what is that which we need to follow with respect to GST law, but this will also help whenever there is a transition issue. One of the common issue or common complaint which we hear from most of our clients is that the person who is taking care of this GST compliance has left the organization. So because of that, there are a lot of issues. There are delay in replying to notices, delay in filing with the returns, delay in claiming credits. So these issues can be avoided when we have a standard operating procedure. The standard GST rate, all of us know that it is around 18%. But still the importance which is being given for this in preparation of SOP is very, very less. So this is something which needs to be taken care. When we have a good standard operating procedure, even though there is a change in the team, say the person who is handling the compliance has left, so it is very easy to train the new person because already he knows, already he has a checklist on what are the steps which he needs to take. This will also help the consultant also, even if there is a change in the consultant, because the consultant can easily understand what is that process which is existing with the taxpayer. So these are the advantages of the SOP. And we have to be very, very careful with the choice of consultant also. The first thing or the first criteria which we need to consider while hiring a consultant is how good he is, what expertise he has before checking on what is that fees which he is going to charge. After you understand, after you get a confidence that he or she is good in understanding the law, she or he can add you value, then you can negotiate on fees. So that should be the process. Many times we have seen that fees is the first filter. So that should not happen. Then adopting technology, we know that most of the reports in GST are online now, whether it could be, it starts with generation of e-invoice, wherein the systems are so integrated that e-way bill will get automatically generated. My returns GSTR 1 or GSTR 3B automatically gets filled with all the relevant data. Therefore, it is very important that we adopt information technology which can help us in doing lot of reconciliation. There have been notices wherein there is a comparison between GSTR 1 figure and e-way bill figure. So there are a lot of many reasons for the differences. The first primary reason is I am sending the goods for job work wherein I will have e-way bill, but I will not have entry in GSTR 1. But department would like to understand such reasons. If I don't have a system of reconciliation to explain this fact, then it becomes very, very tough and the department asks this information for substantial period. Whereas when I have a proper information technology adopted, I can easily generate these reports, easily do this reconciliation to explain to the department. Next slide. So what I have done is I have divided this topic under different heads, mainly under three broad heads. One is under procurement, next is under outward supply, and then last one is under documentation. There are some best practices also which we will try to understand within the given amount of time. In procurement, have you changed the slide, Divya? I'm not able to see the slide on procurement. Divya?
Sir, it's changed, sir.
Okay, thank you. I'm not able to see. What will start? The first important point here to consider is make sure that the purchases are from registered person. This is not only for the fact that an unregistered person will not be able to take the input tax credit on his procurements, which will add to the cost of our procurements. This is also because of the reason that if he is liable to get registered, but he has not done, if he gets into trouble, then our supply chain also may get impacted. If he has substantial demand, then he may demand to compensate some amount from us also. So there could be many such issues when our suppliers will get into trouble. to make sure that the supplies have been planned only from the registered persons. Then there is also something called ROTEP script, which you are going to understand in the subsequent session when Vinny is handling the customs benefit. So ROTEP is nothing but a remission of duties or taxes on export products. So this is a script which I will get when I export specified goods at a specified percentage of FOB. I will get it as a benefit, which I can use it to pay my basic customs duties. I may not have enough exports to obtain this ROTEP scripts. Similarly, there is another exporter who has enough ROTEP script value, but he doesn't have enough imports to utilize the script. So in such cases, I being an importer, I can procure the scripts at a discount amount. The discount generally varies from 2 to 5%. Say the value of the script is 100 rupees, I may get it at 95 to 97 rupees. So this differential amount of this 3 to 5 rupees is going to be my savings, because the script value will have the value of 100 rupees, which I can use it for my basic custom duty. So this is one easy way of making savings in my purchases. Then classification from vendors. This is going to be very important, especially when I am not able to utilize my full credits. I have a lot of accumulation of credits. It could be because of various reasons. Say I am into inverted duty structure, or I am not eligible to get refund, though I am under lesser rate than my input rate which I am incurring. So in these cases, it is very important that I do this exercise of checking the rate of taxes which are being adopted by my suppliers. There is also an option of pure agent concept, wherein I can ask my supplier not to add these values, the additional expenses, to charge GST on such portions, so that my GST amount on my purchases comes down. So these are some planning which can be done. So ITC reversals, wherever I have doubt on my ITC eligibility, then what I can do is I can reverse these credits under protest, or I can also use the option of temporary reversing the credits. I should not do this permanent reversal. I know that I have an option of temporarily reversing this credit, so that I can take it whenever there is a favorable ruling or there is some clarification from the government on this aspect, that I can utilize the credits. In case of RCM liability, time of supply is one of the common issue which we observe, wherein we are seeing the taxpayer missed to pay the taxes, or they delay payment of these taxes. The disadvantage of doing this is that wherever the procurements are from registered vendors, wherein I have the liability under reverse charge, if I'm identifying such cases late after my due date for taking the credits, then I will lose the credits, and at the same time I have to pay back this amount along with the interest. So this is one issue which I'm going to face if I don't identify the expenses on which there is a reverse charge liability. Place of supply compliance. An example to understand this is, say I have to attend a meeting in Delhi. I don't have my registration in Delhi, whereas I have a registration in Haryana. So in such cases, I need to see if I can do some planning wherein I will take this accommodation in Haryana. I will book from Haryana, so that Haryana will be able to take the credits. If I don't do that, if I provide my Bangalore address to my Delhi hotel, then Delhi will charge CGST, SGST of Delhi, which will become cost to me. So like this, we need to do some planning also. Similarly, I need to make sure that when I have multiple places of business, I am giving proper information to my supplier, so that he codes correct place of supply and correct GST number, so that the credit is also taken in a place where the goods or services are actually consumed. Creditors aging analysis. This is also important. If I don't make payment to my supplier within 180 days from the invoice date, then I have to reverse the credit, and I should also pay the interest for such period. So is there any planning which can be done? So there is some interpretational benefit which we can take. If you see Rule 37, it says that if we don't make the payment within 180 days, then credit has to be reversed after 180 days by adding to my GST or 3B returns. What happens if I don't wait for 180 days, but I reverse it before 180 days? I can always argue and contest that in such cases, I don't have to pay the interest because I'm not doing it after 180 days by adding to the returns. I have done it before that. So wherever you see that, so we have to have a system of tracking such payments so that I will identify such cases wherein I come to know that I will not make payment within 180 days and I reverse such credits before 180 days. Next slide, please. Have you changed it, Divya?
Sir, can you see next slide?
Yeah, thank you. Next is a periodic check of registration status of vendors. When I have vendors in hundreds or thousands, it may not be an easy exercise for me to check the registration status on a regular basis. But yes, if you want to do it, there are a lot of tools. If you do Google search also on the GST portal itself, you can check the registration status of the vendor. But disadvantage with the present tool from the government is that at a time you can check only one vendor. But there are a lot of tools wherein you can just copy paste a multiple GST number to check the registration status, and it will throw you a report wherein the registration status may be cancelled or it may be suspended, etc. Those cases wherein it is cancelled or suspended, then you know that you have to be careful. You need to speak to those vendors and take appropriate action because they may not have paid their taxes or your credits may get disallowed if they are not paid your taxes and if you not got your entry in your GSTR 3B. Then documentation, especially when you are claiming the input tax credit, is going to be very, very important. We know that the invoicing has been made mandatory for all those suppliers wherein the turnover, aggregate turnover is more than 5 crores. It is very important that I follow with my vendor for e-invoice as well. If you go to the invoicing provisions, it says that when e-invoicing is required to be issued, but a vendor has not issued the invoice, then the document which he has issued will not be considered as invoice for the purpose of GST law. It is just a piece of paper. So the department can also go to such an extent that it will ask the recipient, wherein it will say that because of this provision, I will not allow you the credit. Though we can always contend that we have satisfied all other conditions, it is only a procedural lapse, but still, instead of getting into such litigations, the taxpayers can have a mechanism wherein they get a declaration. Wherever the invoicings are not being issued, they get a declaration from the vendor that they are not required to issue invoice, or if they have to issue the invoice, then they will comply with it. Otherwise, they will compensate whatever interest or credit reversal which I need to do in future. ITC on CSR activities from October 2023, there is a restriction on taking the credits on those goods which are used for CSR activities. But one value addition here can be what happens if I have any such procurements which I have used for CSR activity for first 6 months, that is from April to September. So I should still be able to take those credits. If I don't want to take that risk, then I will use that. I will just avail the credit, put it in my ITC register, but I will not utilize because interest has to be paid only when I utilize any credits. If I just avail and I don't utilize the credits, then I don't have to pay any interest. The other option is I will reverse the credit under protest. If there is any favorable ruling or clarification in future, I will just go back, identify such credits and re-avail the credits. Next slide, Divya. So in case of outward supplies, decision on claiming or not claiming concession rate of benefits. Example is transportation of passengers. If I'm into transportation of passenger, I have two options. One is I will charge 5% to my customer. I will not take any input tax credit, except on transportation of passenger service, which I get it. I will not be able to take credit on the vehicles which I use to provide this transportation services. Whereas if I opt for 12% scheme, I will be able to utilize the input tax credit which I pay on my vehicles, which can be huge in some cases. So I need to do the cost benefit analysis in such cases before I decide on whether I should go for concession rate or I should go for a regular rate. Then planning in case of Moldgix tools, Ashish also briefly covered in case of exports, there are some planning which can be done. An easier way is don't charge separate consideration for this molds or tools which are getting manufactured in India, which will not get physically dispatched. So factored in that price in the price of components itself. And if cash is the issue, you're not able to recover that entire amount, then you can always go for advance towards such components so that your cash flow issue is also resolved. This issue can also come in domestic supplies. Say I am the supplier to Maruti. Maruti is in Haryana, whereas I have a factory in Bangalore. So in such cases also, unless there is a movement of goods, Maruti, my customer, may have some issues in taking the credit because physically it is not moving. In such cases, I can see if I can use this build to ship to concept, wherein build to ship to will be my own place. Under job work model, Maruti will send the goods. And we know that there is a section 19 of CGST Act which allows me to do this. Then valuation of cross charge. This is also briefly discussed by Vikram Kataria. We need to be quite careful when my recipient is unable to utilize the full credit. When my recipient unit, say my unit in Tamil Nadu, is not able to utilize full credit, in such cases, I cannot have any ad hoc value in my invoice. I should follow the principle which has been provided in circular number 199, which provides that I can exclude the employee cost. So this is something which is very important. If I don't do this, then I may end up paying higher amount of taxes and recipient also will not be able to utilize full credit. Next slide, Divya.
Next slide is documentation.
Yes.
Thank
you. Yeah, thank you. What we have seen is that e-way bill issues are very, very common. And because of the limitation, the department will catch hold of the goods. They will say that you have to pay these taxes, then you go for an appeal. These issues will happen when I don't take care of my documentation appropriately. When I have this automation, wherein when I generate my e-invoice, e-way bill also should get generated automatically so that there are no differences with respect to information such as the tax amount, HSN, invoice amount, etc. Whenever you have a manual system, then we may end up doing some mistakes, wherein because of these differences, department will always ask for 200% penalty. Otherwise, you have to wait for appeal, which will take substantial time to get the goods released. So in order to avoid this, as I was discussing, automation is something which the taxpayers should consider. Then agreement terms with the vendor is also very, very important with respect to mainly because if they don't comply, if they don't file the returns within time, I may not get entry in my GST to be in a appropriate time, which will delay my credits also. Authorization of ITC reversal. So we have seen many cases wherein the reversal of ITC would be done based on the departmental instruction by the accountant or the person who is handling the GST compliance, and the higher authorities, the finance head or the finance director, they will not get to know about such reversal at all. So there has to be a system of authorization for any ITC reversals. If there is also a system of MIS, wherein this MIS also captures the total amount, the ITC reversals made as well, along with other information, such practices can be avoided. Any reversal, any payment based on the department instruction, you need to make a confirmation that it is actually required. If you have a consultant, you have hired or the expert is there, you can always consult them, take confirmation, then only you should go ahead with ITC reversal or any tax payments. Initial disclosure letter. So this is something which we have been recommending our clients from many years. In central excise law as well as service tax law, this was something which was there in the law itself. It provided for providing basic information. However, in GST, this requirement is not there. But still, we suggest the taxpayers that you file your initial disclosure letter, which will have all the basic information. What is that you are producing? What is that services which you are supplying? What is the HSN? What is the rate of tax you are adopting? If you are going for concession rate, then what are the conditions you are fulfilling? What are the expenses on which you are paying taxes under reverse charge, the rate of tax? If there is something on which you are not paying, then you can make sure that you mention your understanding as well and file it with the department. The biggest advantage with this initial disclosure letter is that the limitation period can be limited to only 3 years under section 73. If there is a higher penalty which is being levied saying that you have suppressed any information, it is intentionally or avoiding any taxes, we can always show that we have always made the information available to you, and this is the acknowledgement which we have for providing this information. Automation and SOP we have already discussed. Next slide, Divya. Which is the slide which you are on, Divya?
It's exports, sir.
Exports. Okay. Exports I'm not going to discuss. I saw that Vinny is going to cover most of these points. Can you go to next slide?
Next slide.
Is it other compliance?
Yes, sir.
Yes, Madam.
Yeah, thank you. The system of reconciliation every month is going to be very important. We should not have this exercise of reconciliation only when department is taking up the audit or when we are filing the annual returns or GSTR 9C report. That should not be the case. The reconciliations are going to be an important exercise every month. We should make sure that there is no difference between GSTR 1 and GSTR 3B. No difference between e-way bill report and GSTR 1. If there are differences, then we should know the reason for such differences. So reconciliation system is going to play a major role. Then make sure that you reply to departmental letters or notices within the due date. If you are not able to provide complete information, then instead of telling the department that you will furnish all the information only at a later stage, furnish whatever information is ready, and for the balance information you say that this is the additional time I need, and by this time I will submit the information. So this has to be the practice which you should have. And most of the times we get our correspondence on our portal. So have a system of verifying your portal under the notices or the letters tab to see that if there are any correspondences, they are addressed within the time. Next slide, Divya. Just confirm if it is on. Yes.
Mahadev, I think we have 2 more speakers and we have only...
Last slide, sir. 2 minutes, sir. 2 minutes.
Finish fast.
Yeah.
Because we need to give them time. No? They also prepared.
Fine, sir.
Yeah.
Other best practices, have a system of training the GST compliance person or the accountant who is handling the GST compliance, and also have the system of maker and checker concept. Then have a system of GST compliance review. If you can't hire an additional person for this, if you have an internal auditor, then make sure that he covers the GST aspects as well. And there are good online materials available on various websites. ICI IDTC website itself has lot of information. There is a background material which can give lot of information on the law. Then Hiregange Academy is there, hnaindia.com is there, Tax Bureau, Tax Sutra. So these are some of the resources which can be made use of for understanding the law.
All participants. The topic that has been allocated to me is GST refunds. So like any other law, like for example, income tax law, GST also we have a refund provisions and subsequently, I mean, read with rules as well. Like audit, assessment, the refunds has its own proceedings, wherein section 54 to 58, the refund provisions is envisaged in the act. No, as per the sections, the rules also there, covering from 89 to 97A. These are the specific provisions relating to GST refunds. Now, various, I think, Divya, you have to move the slides. Come next. The scenarios of the refund. When does a refund scenario arises in GST? Like all of us are here professionals and we have a bit knowledge about the taxation. Mostly it will be on the zero rated supply. Earlier, in GST it is termed as a zero rated, but normally in our regular practice, what we will call it is exports. So whenever an SSC is having his services or goods is exporting to a country outside India or supply to SEZ. So supply to SEZ also is termed as a zero rated supply, thereby the situation of refund arises. So on their output, there is no GST because they are into exports. However, on the vendors, whatever they are making payment, so that they can go for the refund as per the provisions which I said earlier. The second scenario that what law envisages is that inverted duty structure. So what is inverted duty structure? When your output is at 5%, say example 12%, and your input comes with 12%, 18% or 28%. To give an example, say any tractor manufacturer or rice milling machinery or any agro-based industry. So all these industries where their output is at 5% and their inputs is at 12, 18 or 24%. So this is the inversion. So this is typically they are into inversion, causing with the inversion, they can go for the refunds under GST. Apart from this, as we know, wherever wrong taxes has been paid under section 77, that is instead of IGST, we have paid CGST, HGST, then that time also the correct taxes can be paid, and the wrong taxes, whatever they paid, they can go for the refund. And apart from this, TDS and TCS transactions for government contracts and this e-commerce transactions, wherever they are not able to use this TDS or TCS amount deducted, that they can go for the refund. And wherever excess payment of tax has been done, say instead of depositing 10 lakhs, I have deposited 1 crore rupees. Obviously, no need to say it's a constitutional right under Article 265 that you can go for the refund without any time limit. Next, Divya, now I go for what is zero rated supply. So zero rated supply, as I already told, it is envisaged in the provisions of section 16 of IGST Act. What is zero rated is directly exports. And the next transaction is, yeah, definitely if I have some time, I will definitely take, sir. I am seeing some questions in the chat box. Definitely I'll take at the end. Otherwise, at least I'll give my email ID so that you can send a mail so that I'll definitely reply. Due to paucity of time, this I am making these remarks.
Venkat, you can send it later because
Yes,
I
yes.
don't think we'll have time. Still,
Yes, sir.
she has to take, I have to give closing remarks. Go ahead.
Yes, sir. Sure. Yes. So this zero rated supply was into where that is section 16 provides, embodies in the act that what is zero rated supply, typically what is exports, that is goods, that is services going outside India, the consumption that is happening outside India, and supply to SEZ. Even the FCZ is located to next to your company. It is treated as a IGST transaction and there is no GST on that. So that is the zero rated supply as for GST. So few of the issues I just wanted to discuss under the zero rated supply. I mean, when any exporter files a refund claim and he has not filed a LUT, is that a major crime? Divya, you have to change the slide, please. Just try to give the control to me. I'll just change it. This LUT, filing of LUT is only a procedure lapse. It also says in circular number 125. If you are not giving your circular, I mean, if you are not furnishing your LUT, and you have filed your refund application, there are many officers who have rejected the refund claim, but that is wrong. So your filing of LUT, you should not. It is a procedure lapse for the for suppressing or for deviating procedure lapse. The substantial benefit called refund provision should not be denied. Is the law that has been echoed and given in the circular by the CBIC as well. So few of the issues I faced in myself in our office, wherein we subsequently for non-furnishing of LUT they have paid and then we got the refund. All that happened, just for our knowledge. And the Supreme Court case laws also I have quoted Mangalore Chemicals, and it is part of with the presentation. Later on the team can share with you all. Formica India versus Collector of Central Excise. This is one of the case. And whether an exporter has an option to go one few consignments with payment of tax and without payment of tax, yes, it is definitely allowed under the law. Earlier we used to call it as a rebate. So with payment or without payment, he can plan according to his ITC accumulation. So that is the law provides. So, but only thing he has to ensure that ITC cannot be taken in the both applications. I mean, there should not be double claim of ITC. The time limit for the recredit, say any exporter is filing the refund application, for some reason he issued the deficiency or rejected the claim, or RFD 06 has been given, you have applied for 50 lakh rupees refund and 49 lakh rupees has been approved, sanctioned 1 lakh rupees has not been approved for whatever the reason, and if that rejected amount immediately it has to be recredited. But what is the problem presently we are facing? It is taking again multiple follow-ups we are doing with the department officers. So something which here timelines have not been envisaged for recrediting. This few suggestions also from our office also we have given, and we have brought to the knowledge of the Joint Commissioner and the Commissioner level. So maybe the law or circular or instructions can be given in this regard. So this is one thing. Then erroneous refund. Say the exporter net ITC 89.4, it restricts only inputs and input services. It does not extend to the capital goods. So under LUT, if I am filing a refund claim, now say by mistake I have included and I got the refund. This is one of the example I have taken. Then that is a erroneous refund. On capital goods, you are not supposed to take the refund under LUT method, that is input tax method, but you have taken. What is the recourse option? Is you can pay back all the amount along with interest, and PMT 03, all of the amount whatever you have paid and whatever the erroneous refund, they will restore as a credit to your electronic credit ledger, and interest will be their our cost. That circular is there in 177, I think in July 2022 they issued. Refund of ITC taken on capital goods. Exactly whatever there are two methods of claiming the refund. That is, one is rebate method, that is export with payment of tax, and export under LUT. Under LUT method, that is a formula method. The capital goods, the input net ITC restricts only to input and input services. So it excludes expressively the capital goods. Hence, the exporter can go under with payment of tax. So whether there is a possibility to claim capital goods refund, yes, it is there. Only thing under with payment of tax. Next. And very often under the zero rated tax that we are observing, many deficiencies or the show cause notice have been issued by the departmental officers saying that there is no FIR, there is no FIRC. That is technically what is FIRC, FIRA is that RBI has given mandatory to all the banks to issue FIRA, that is advice. At the end, the nomenclature, it comes as a advice instead of certificate. That is only very frivolous thing, but that has been used on the yardstick to reject all your refunds. So this is, I think, I have brought to the knowledge of the Joint Commissioner, Ms. Archana Nayak. So then they shared all this RBI, whatever the instructions. So that RBI instruction clearly says that upon the exporter's request, normally banks will issue FIRA, that is advice only, but when you are specifically requesting to issue FIRC, that is certificate, the banks are bound to issue to exporters the certificate. Alternatively, what export community can do, they can take one letterhead. I mean, on their company, they can get one seal and signature. This is we hereby certify that this is amount released in so and so. All the details they can put and they can give to the authorities. That also they have taken positively, and many refunds are getting processed. And the PayPal, whatever online few apps are there or some portals are there through which the relation is happening. One of that is PayPal. So that many departmental officers have not taken, appreciated the for the sanctioning of the refund. So that also has been dealt in a fortune trading research LLB Madras, Honorable Madras High Court. So that is also as part of our presentation that will we can get it shared. Whether 2A and 3B is mandatory, though it is not mandatory as per the law, but it is coming in the only in the circular. But in the protest of the interest of the revenue, the officers do ask us, and we have to do reconciliation of 2A, whatever is reflecting in our 2A, and furnish the statement. Then recovery of exports proceeds. For export of services, yes, I understand there is a, if non-relation within 1 year or 9 months, that is a refund and all whatever we have got, we have to pay back along with interest, all that is there. But export of goods, it was not there. 96B, they have introduced from with effect from 2023. Next, Divya. So all this 1.5 times artificial restriction for claiming the refund. What is this artificial restriction? So whatever the, say for example, if a manufacturer is exporting any product of worth 100 rupees, he can value in the export international market 500 rupees also. If he is clearly clear, if the same product is clearing in the domestic market for 100 rupees, and the international market it is going for 500 rupees, for the refund purpose he can claim up to 1.5 times, that is 150 rupees he can put and he can claim the refund. That is the essentially it says 18A4. It's clearly going behind the aspiration of the statutory provisions, that is it is coming only in the rules, and definitely this has been challenged in many high courts, and it will go as it will be the rule itself will be challenged, the virus and this is 1.5 times. Already Karnataka High Court Senior Counsel Advocate Raghuram sir has argued, and it came in the favor of the SSC. One-on-one correlation. Obviously, this problem was little there in the central excise regime, service tax, and VAT credit rules, but now everything is linked in course of furtherance of the business, GST. Now, whoever under the thought process of they come from the existing law, that is previous law, the officers are still demanding or creating such certain problem, like you correlate your accommodation services or traveling services. Say if a company, their engineers are traveling to United States or any outside India, and the traveling charges for providing that implementation support, all that they would have traveled. So all that is eligible, and it is one-to-one connection is not required, and that law does not establish that, law does not recognize that system now itself, because in the section itself it is in or in furtherance of the business. So that is very broad to cover all this. One-to-one correlation is not required. FOB value or invoice value, whichever is the lower, this is also very arbitrary and going against the provisions of the GST Act, and it will also be quashed, and in many high courts it has also been challenged. Already the circular is told invalid in Tata Steel Limited versus Union of India. Similarly, like Tonbo Imagining India Private Limited, what I referred in 1.5 times. So same thing, this also will go. The intermediary services, please note this, Rupa Madam gave elaborate detailed picture of this intermediary services. So intermediary services, there is a fruitful circulars also. One thing the exporter should keep in mind, wherever there is clearly a commission, that time itself the liability does arise. Otherwise, if it is on one principal to principal basis, no liability, it is clearly an export. If it is a principal and agent relationship, that is categorically all the, we would like to suggest all the exporters or all the professionals who are attending this call to revisit their the understanding, master service agreement, all that, check what is that they are providing the service, all that. So that is the intermediary services. What is the game changer here is that principal to principal basis, no, it is export of services. Agent to principal relationship, there we have to examine the clauses, all the terms and conditions. The compensation says whether it is refundable or not. Few, like cement manufacturing, steel manufacturing, they import coal. When they import coal, the coal cess will be levied. Now the coal cess, whether it is refundable or not, yes, it is refundable, provided the particular who is importing is putting into use or captively consuming, and further he is into export of his products, that time it is definitely refundable. Next, Divya. Then refund of accumulated ITC under this export of nil rated or exempted goods. Whenever I am exporting nil rated goods, say for example, I am into pharmacy or I am manufacturing certain items which are exempted. Say I am manufacturing liquor itself. This is exempted and nil rated, both are different. If I am exporting, notwithstanding the input crate restrictions, for a person who is into export of these products, the crate is eligible and he can go for the refund. With very simple example, I am telling ATF, if I am a liquor manufacturer and if I am exporting, all the input tax credit relating to manufacturing of that liquor, because I am into zero rated supply, I am eligible to take input tax credit. Consequently, the refund is eligible. The refund of unutilized by merchant exporters, 1894 and 1894B, the issue is, I'll just elaborate in just 1 minute because it is very contemporary issue now. Say for example, if I imported goods under advance license and I am exporting and I am claiming refund under 1894, the department is saying you have no business to claim under 1894. You have to go under claim under 1894B. Now, whatever I have claimed under 1894, it will be treated as an erroneous refund and the interest and penalties, and then I will be pushed into to claim under 1894B. So this same follows with merchant exporter and also the UOU supplies, all that. Recently, we have handled a few such cases wherein wherever we have calculated what could be the refund eligibility if an exporter would have claimed under 1894B. So to that extent, demand cannot be made, and remaining whatever is there, that only the demand should be sustainable. So that is one proposition, and this is echoed, or the reference was given by the Madras High Court judgment also recently. So that is also there. So it is a dispute resolution mechanism kind of thing that they can do. So this is before the department issues under 1894B, you calculate what is eligibility under 1894 and you can submit the, the remaining thing, you just comply as per that. When you give me 5 minutes, I'll finish. Exports with payment of tax as the many circulars are there, like scheme, it will be coming. If your refunds is stuck with mismatch between GST 1 or your returns or your shipping bills.
Venkat, you may have to hasten a bit. 2 minutes, try and close. We will,
Yes,
we have to close, but we have to also see that
Yes,
Vinny
sir.
gets a chance. Otherwise, there will be nobody left. Only I will be listening to Vinny. That's all.
Sure, sir. Yeah. So this basically this with whenever we are going for with payment, there will be certain glitches due to certain mismatches. Your refunds is held up. That time see that these circulars are there. It is there in the presentation. Our team will share later. As per those circulars, you have to meet the refund officer and provide it in Concord table and get it processed. The FO value, CAF value, I told already. Then we are going to move. Divya, please change the slide, please. I'll just take 2 minutes in this. The next major this thing what we have discussed is ideas, that is inverted duty structure. In my intro, whatever I told that your output is at 5% and your input starting from 5 to 12, 18, 28. That is the inversion. So whenever the scenario is that, based on that, you are allowed to file the refund application under inverted duty structure. Please remember, whenever you are filing inverted duty structure, input services are not allowed to claim under this category. Only inputs are allowed and capital goods also not allowed. But whenever you are making this application under this category, very recently after VKC judgment, the revised formula given by the council, and it was affected also by the respective state governments, all the state government and the central government. So as per that new formula, if you apply for the refund, a bit optimization can be made. Come next, you can go to next. Here you can go to next. Yeah, next. This SEZ is something, whenever I'm supplying to SEZ, this whether supplier to SEZ itself is only treated as zero rated. For some reason, preliminary expenditure would have been incurred by the SEZ unit itself or the developer, whether they are eligible or not. Here is the Platinum Holdings Madras High Court judgment. That is the answer. They are also eligible for the refund. All the procedural things are there, and deemed exports is there. The procedural things I have made part of this presentation itself. I think always you can come back due to paucity of time. I am closing this session. Otherwise, you are always welcome to my email ID will be there. Please revert to me. If anything is there, definitely I will answer. And all the questions, whatever is there, I will take from the chat box. Definitely I will try to answer all of you. As a closing remarks, only 1 minute I will take. Deemed exports is there. Deemed exports is nothing but under section 147, it is notified whenever any supplies to EPCG holder, advance license, or the EOU, that is called deemed exports, either recipient per se. I mean, on apparent basis, there is no exemption for these transactions, like under central excise, ARE 3, ARE 1 procedure we used to follow. But under GST, all these transactions on upfront basis, it is made liable to GST, but refund is secured to recipient or the supplier, subject to payment at the first go. So certain circular is there, certain procedure is there. All that is there in the circular 14/2018.
So the first which we are going to study today is a very good beneficial scheme under customs regulations, that is manufacturing and other operations in a warehouse, which is in simple terms called as a bonded manufacturing scheme under the customs law, which was very recently amended and introduced by 2019 and 2020 regulations. This scheme was brought in to benefit the manufacturers in India. So the benefit of the scheme is a duty deferment for those who are importing the goods, raw materials and capital goods, manufacturing finished goods out of it, and then supplying it whether within India or exporting it outside India. So the scheme works like this. You have to declare your factory as a bonded warehouse under customs regulations by filing a simple application on the Invest India website. The process is very smooth. And then once the factory is declared as a bonded customs warehouse, then the importer can import the raw materials and finished goods without payment of basic customs duty. Okay, and then use the raw materials or the capital goods for manufacturing of goods, and then it can be the duty payment requirement comes when the goods are removed from the factory, from the boarded warehouse. So if the goods are exported, then BCD is entirely waived off. Earlier, what used to happen was when an exporter is importing raw material or capital goods, he had to pay BCD, that is basic customs duty. And then at the time of export, he will get the duty drawback. But the drawback percentage would mostly be lower than the actual amount of duty paid at the time of import. So now the benefit to an exporter is that the duty payment has been completely waived off if this scheme has been applied to. Then for the domestic sellers, those who are importing raw materials or capital goods, at that time, they will get the benefit of BCD, that they don't have to pay the basic customs duty, that is BCD, at the time of import of such raw materials and capital goods. And when they are removing the finished goods, which are made out of, by using these raw materials, at that time they have to make the proportionate payment of duty. That is duty which is proportionately applicable to the raw material which is used in the finished goods. So based on the quantity of the finished goods which is being removed out of the factory, based on that you have to make payment of the basic customs duty on the raw materials which were earlier imported. Now the benefit here is that there is no time limit. There is no specific time limit that within this time you will have to remove the goods and make the payment. So there is an interest benefit involved here. And the best thing about this is that whenever you have a huge capex investment coming in, at that time the schemes become very, very lucrative, because for the capital goods, since there is no time limit, the duty requirement, the duty payment requirement will only be at such point of time when the goods would be removed from the factory. So say capital goods have a usable period of 10 years or 20 years. So it actually becomes a duty deferment up to a period of 20 years. So interest is the thing which gets benefited. Then the second most important benefit of this is in those industries where there is a higher holding period. That is, raw material is imported, say today in August 24, and the finished goods, the lead time of manufacturing is say 6 to 8 months. So after 6 to 8 months, there comes a duty payment requirement. So in these two scenarios, the scheme becomes very, very beneficial. So if you are a chartered accountant or if you are a business unit, you can always suggest this to such businesses who are having these kind of inputs and they are majorly into imports. Here, the only disadvantage of the scheme is that when you're applying for this scheme, you will not get the duty drawback under AIR, or that All India drawback rate, and you will not get the benefit of RODTEP scripts. That is an automatic refund of script which is available at the time when you file your export shipping bill. So these two things will not be available. Come to the next slide. Yeah, so I've already explained this. Go to the next. The next thing which we are going to talk about is a preferential or a free trade agreement. So whenever you are importing or exporting or dealing into this foreign trade agreements, there are certain norms of World Trade Organizations which are applicable. So Article 1 of this GATT, it specifies that no country can accord a special status to any product or any product which is emerging from a specific area or from a specific country. But there are certain exemptions which are given under Article 24 and Article 5 of GATT. Now, under these comes these free trade agreements and preferential trade agreements. Free trade agreements are a list, it's more of like a negative list, whereas preferential trade agreement is like a positive list, wherein in the preferential trade agreements, there is a list of goods which are given that on trade of these goods between these two member nations, there will be a reduced rate of duty. or no rate of duty. It will be entirely duty free. Whereas in case of free trade agreements, it has a wider scope. It comes like a negative list, like almost all the items of trade between these two countries will be at a reduced rate or at a specified rate or at no rate, and except certain specified list of things. So here the benefit comes is that whenever we are doing a review, a customs review, or whenever we are seeing a business entity which is having a very high imports or higher exports, so in those cases we can always look at from which all countries the import is happening, and then identify what are the free trade agreements between the governments which are available, and whether the entity is taking the benefit of that specifically reduced rate of import. Also, you can do the classification up to 8 digits level to find out that whether the entity is classifying the imported goods correctly in its bill of entry and whether it is actually taking the benefit of the free trade agreements. Similarly, strategic level planning can be suggested at supply chain level to identify that having major exports to those entities wherever India has a free trade agreement. Because suppose say India has a free trade agreement with Australia. So when the goods are originating out of India and exported to Australia, then there is a reduced rate of duty under FTA of say 5%. Whereas you also have a manufacturing operation in say Saudi Arabia. Now Saudi Arabia and Australia are not having such kind of free trade agreement. So what can be the value addition in your Indian factory to have suppose if you have more than 30 to 35% of value addition in India, then it will be called as the origin, the place of origin will become India for that product. So in those cases, if you simply say assemble the products or increase the value addition in your Indian factory and then export it to Australia, in those cases there can be a significant value addition. And when you for the companies which are having say manufacturing operations in say more than 10 countries or 12 countries, in those cases there can be a strategic planning which can be suggested by studying these foreign trade agreements and preferential trade agreements. Come to the next slide. Yeah, after this. So these were just a list of the free trade agreements where India has entered, which anyways we can have a detailed look on later. Then comes the duty drawback. So duty drawback is what? Duty drawback is just a scheme wherein we get the refund of the duty which we paid at the time of imports. Now this is not exactly the refund because a specific rate has been provided for each of the products. So whenever you are exporting the goods, the specific to that HSN, whatever percentage of say 1.2 to 1.3% on an average has been prescribed for each of the goods. So to that percentage of the value is what is getting automatically credited to your bank account directly. That is what is called as a duty drawback. So now this duty drawback is also of two types. One is when you export the goods and realize foreign exchange, then the shipping bill is considered as an automatic application for this duty drawback, and immediately when you file shipping bill, the amount of duty drawback is credited to your account. The second type of duty drawback is Section 74 duty drawback. So under Section 74 and 75 under customs law, this duty drawback has been explained. So in Section 74, it is a very specific drawback which is regarding re-export of the goods which are used in India. So there was an import of certain machinery on lease or maybe on rent, and it was used for a certain period of time, and then it was exported. So those specific cases fall under Section 74, wherein the refund is given based on the usage of the goods and the period of usage and depreciation, specific formulas which are prescribed. So for Section 75 drawback, which is almost applicable to all the products whenever they are exported, here there is an all India rate. That is a normal rate which the government has determined and prescribed for all the industries, all the products. So when we are doing a check on an exporter company, we can make a list of the goods which are exported and identify that how much is the actual duty paid at the time of import of the raw materials which are used in the manufacturing of these finished goods, and how much is the actual drawback received, and then compare it. Suppose say at the time of import you have paid 10 lakhs as a import duty, but when the same goods were exported after manufacturing proportionately, then you received a drawback only of 1.5 lakhs. So there is a loss of 8.5 lakhs to the entity. So you can simply suggest the entity to apply for a brand rate or a special brand rate to fully compensate for the actual duty which has been suffered. So based on this, you can make an application to the Norms Fixation Committee in Delhi, and they will take certain information of the duty which has been paid on certain of the goods which are imported, which are being used in the manufacturing of your final product, and then what is the rate of AIR on the final product, and they will compare it, and based on the actual computation, your specific entity will be given a specific rate which is called as a brand rate. So this benefit can also be taken and can be explored wherever there is this kind of gap wherein you are paying more duty at the time of import, but the drawback rate is very less. Next. Yeah. Next. Yeah, just keep it here. Yeah. So the another benefit which comes at the time of export is an RODTEP, that is remission of duties and taxes on exported products. It has recently come into effect from Jan 21. Before that, it was called as MEIS script, if any of you have heard of it. This is nothing but an export promotion scheme. Government wants to promote exports from India. So on export of majority of the products, they had declared a percentage rate. Based on that percentage on your value of the goods exported, a script is getting credited to your electronic ledger, which is maintained on the IceGate portal. IceGate is a customs portal where whenever you make an export, you have to file a shipping bill online there. So in the shipping bill, if you tick that, yes, I want to avail RODTEP benefit, I want to avail the benefit of RODTEP scheme, you have to tick it as yes. Immediately as you tick it as yes, the amount, the whatever is the RODTEP rate specified, it is specified in Annexure 4R in this RODTEP scheme. So based on that rate, the amount of script, a script is nothing but just like an electronic document. Okay, that value gets credited in your ledger. Now that ledger can be used for payment of import duty, any basic customs duty in any other import, or it can also be sold to the other importers. That is, you can sell it, you can just, that electronic ledger is just transferable. You can transfer that balance to any other importer. So the benefit here is that, okay, this RODTEP script, suppose you have some very heavy imports or capex imports which are going to happen. So you are not having this RODTEP scripts. So you can also try purchasing from the market, because a rate of 83 to 99% is something which is usually available in the market. So based on the market forces, the rates are determined, which means that if suppose you have to pay a basic custom duty at the time of import of say rupees 100, so you can get this script in the market for 83 or 85. So there is a direct benefit of 15 rupees or 17 rupees available. So like this, we can see that how RODTEP scripts can be sold and also purchased from the market. Next. Yeah. So next comes is AEO. This is nothing but just like an accredited taxpayer. A person who is a compliant exporter or a compliant importer is given a special treatment at the ports. In simple language, if I can explain it. So if you are a compliant exporter, you can apply for, make an application for an authorized economic operator. Okay, so they will take your compliance measures and will give you an AEO accreditation. Initially, you will get a T1 accreditation. Then after applying for a certain period of time, maybe 3 years or 5 years, you can apply for T2, T3. Likewise, TLO certification is also there. Next slide. So the benefit of getting an AEO accreditation is the first and most important benefit is that you get a priority clearance at the ports. So, which I think is the most important benefit which any importer or any exporter can get. You always get a frontline treatment at the port. You have a specific CRM manager in the customs office. You get a hassle-free, query resolution, everything, and you will never be flagged as a high risk importer or exporter, which means that your IGST refunds or your export incentives will never be held. You will always get an easy clearance for all your export incentives. Next, please. Yeah. So next, then comes the EPCG and advance authorization. Now, this is more or less like, you can import the capital goods without payment of import duty, that is EPCG scheme, or you can import the raw materials without payment of customs duty, that is advance authorization scheme. Now, difference between these schemes and mover, you will say that the first scheme which we have heard of, mover. So there also we are getting a duty deferment or no need to pay the duty when you are an exporter. Similarly here also, but the problem here is that if you want to avail this exemption under EPCG scheme, you have to meet certain export obligations. So suppose at the time of import, you took an exemption of say 100 rupees, that is a custom duty exemption availed at the time of import of certain capital goods which are used in the manufacturing of certain materials which will be ultimately exported. So now, since you've taken this exemption of 100 rupees under under this EPCG scheme, now you will have to make an export to the extent of 600 rupees. That is 6 times of the duty which has been saved. So this is an export obligation which has to be fulfilled within a certain block period, which can be 4 years, 6 years, and usually it is extendable. So these complex requirements of meeting the export obligations was not there under the mover scheme. So that was more beneficial scheme. But certainly EPCG scheme is also beneficial. Now EPCG scheme for procurement of capital goods is also available for indigenous procurements. That is when you're procuring from within India, that is you're buying capital goods from within India, but you are a export entity. So in those cases also you can apply for an invalidation letter and obtain based on your EPCG license. So this can be very useful. Suppose you're purchasing any capex machinery like lifts and all, wherever the credit eligibility under the GST law is doubtful, and you are a 100% export entity, you have an EPCG license, so you can even if you are procuring it domestically, you can procure it under the EPCG license, which means that you can entirely avoid the cost of GST on that lift purchase. Okay, because since you are an EPCG license holder. Likewise, there are many other benefits. I'll discuss it in detail in my notes. Come to the next slide. Yeah. So similarly, advance authorization is an exemption which is available to an exporter at the time when they are importing the raw materials, so they can import duty free and then use such raw materials for manufacturing finished goods which are ultimately exported. So to obtain this advance authorization license exemption, again you have to make an application, fulfill the CON norms, which is nothing but a standard input output TOPS. Okay, so you have to give the percentages of what is the raw material which is being used in your finished product, and there has to be some 15% value addition minimum which is required to obtain this advance authorization license. So once this license is obtained, then you can make the imports, duty-free import procurement can be there for the raw material, and it can be the material can be used and then goods can be exported. So again, there is no need of duty payment. Now here, one problem is there is when you have a advance authorization or an EPCG license, at that time you can import the goods using both. You can get an exemption of BCD, that is basic custom duty, and also IGST. But the problem is that when you are getting an IGST exemption also at that time, then your refunds, IGST paid refunds at the time of exports will be restricted because of rule 9610, which is there under CGST rules. So the rule restriction under rule provides that if you are an exporter and you are making an export not under LUT but under direct IGST payment rule, wherein you get an automatic refund, which Venkat Narayana sir has recently explained. So in those cases, at the time of import, if you have taken this advance authorization license benefit, then they will restrict your IGST refunds at the time of export. So although the rule has been amended now, and now it provides that the refunds will be restricted only when you have availed the IGST exemption also under advance authorization and EPCG authorization. If you have taken only the BCD exemption, in those cases, your refunds will not be restricted. So with this, now I have only one more scheme left, that is status holder. Come to the next slide, please. So status holder, next. Status holders are those entities which are more or less like AEOs only, which I just discussed, the accredited compliant exporters. They get certain benefits. Similarly, status holders are also, some of the entities which get these benefits of, they get these status like 1-star, 2-star, 5-star exporters. So they have to comply with certain of the requirements which are there under the DGFT procedures. And once they comply with those procedures, they get this specific status holders certificate. So based on this, they get a lot of benefits like faster clearance for CON norms updation, and instead of a bank guarantee, they can furnish only an LUT. They can get self-certify their own certificate of origin. So like this, many benefits are.
I'm going to take about 3-4 minutes. All the books which we have displayed, each of the authors, we have tried to see whether we can match the author to the sectoral, talk. We have, of course, many other authors and many other books, but all these books are available at, you will have to Google it. We don't have it. Some of the things which I thought were important in this tax planning side is, remember, the Constitution of India is very powerful, and no law in this country can be made such that it is against the Constitution. So you have a right to equality, where if equals are not treated equal, then the courts will quash it. You have freedom, Article 19, which gives various freedom to do business, information, etc. And if people violate it, then even the tax law, which muzzles such freedom, can be found to be ultra vires the Constitution. Also, the penalties are not automatic. So there are some safeguards there. We have also protection to life, personal liberty. These are especially required to be known when search, seizure, arrest takes place. And we find sometimes the authorities use these powers without even knowing what they can do, what powers they have or don't have. Next. Some of the other articles are, if we look at it, religious institutions have a lot of exemptions. The state has specific powers, so in such case, the center cannot tax it. There is also one very important Article 265, which all of us as citizens of India should know, that no tax can be without authority of law. And there are also safeguards that nobody can attach your property just like that. So this happens in the department. Sometimes your debtors are attached, or your bank account is attached illegally. There is also a deemed sale versus service definition itself, which sometimes is useful, especially for the works contract. Next, please. All our speakers, they also, while looking at the law, they look at legal maxims which are settled understanding of law. And sometimes they are required because when the law is not logical, when the act is not logical, the rules do not work within the act, notifications are beyond the rules and act, circulars, of course, quite frequently need to be challenged and quashed. There is also one understanding, department does not understand law and they have scant regard for the law, but law is very powerful. So we can insist that if your case is the same as something where there has been a decision, you can insist it is so. And in case the officer does not follow it, write to the higher up saying that this is contempt of the court and mark a copy to the court if you have the guts. There is also an understanding that when there are decisions taken in the same commissionerate without considering their own earlier decisions which were different, or without examination, it shows lack of diligence. Where there is orders up based on assumptions and presumptions, then there can be quashed. Remember, this can be even if you have a very bad case. When it is impossible, the law today under GST requires the supplier's compliance to be ensured by us, but there is no mechanism for us to verify it. Once they give a mechanism, then it is legal. Otherwise, supplier's non-compliance cannot lead to your denial. However, courts have not really given clear wordings there, but they do give relief. Also, if we look at some of the powers like arrest and search, it is for specific levels that person cannot further delegate it.